I'm Shauna Smith alongside Brad Smith.
All lower following a record close for the S&P 500 and the NASDAQ Composite. So let's get right to it with the three things that you need to know this Friday morning as you prep for the final trading day of the week. Yahoo Finance's Pras Subramanian, Jared Blickery, and Madison Mills have more.
Yeah, Brett, hey, a big win for Tesla and Musk. Tesla shareholders voting to reapprove the CEO's 2018 multi-billion-dollar pay package, which was struck down by a Delaware judge earlier this year. Tesla shares slightly higher here in the pre-market. Now, the vote doesn't change the judge's decision, but it may give Tesla a strong case to get that ruling overturned. And shareholders also approved moving Tesla's legal home to Texas from Delaware, which is a move Musk also called for after his pay package was voided. Musk also gave updates on Tesla's robotaxi program, possible new vehicles, and a bullish forecast for Tesla's Optimus robots.
And stock futures moving to the downside after the S&P 500, NASDAQ, and NASDAQ 100 closed at record highs on Thursday's session. The tech-heavy NASDAQ boosted by gains in Nvidia, Apple, Microsoft, and a number of semiconductor stocks. Equities overall rising this week on investor hopes that inflation is cooling. But according to the CME's FedWatch tool, the odds of a rate cut in September have increased by over 17 percentage points from last week alone to around 64%. And that's after a number of economic prints this week have shown prices moderating.
And Apple is the most valuable U.S. company for the first time since January. The iPhone maker closed Thursday's session with a $3.285 trillion market cap, overtaking Microsoft's by just a hair $4 billion there. Apple's been in the red for a lot of this year, but recently broke out after unveiling its AI strategy at its Worldwide Developers Conference.
Our top story this morning, Elon Musk securing a victory in his multi-billion-dollar pay package vote. Musk showing some love to his supporters during his speech to shareholders after the results.
Hey guys. Welcome to the Tesla shareholder meeting. And I just want to start off by saying, hot damn, I love you guys. Yeah.
Well, hot damn, Tesla shares are higher pre-market. Here to break down the results and the details of the vote and what we learned in the shareholder meeting, we've got Yahoo Finance's Pras Subramanian. Pras, my goodness.
You know, it's Muskapalooza over there, right? I mean,
Yeah.
This really cheering. It seemed like they actually increased the volume when they announced the results of the vote for his pay. The people cheering was all of a sudden loud and really kind of raucous. So yeah, big win for Musk and Tesla here. Obviously, for him personally, he gets his pay package. He's saying he's very excited. Very happy with the shareholder vote, but also that redomestication of the company in Texas that also passed. Kimball Musk and James Murdoch, they also got approved there. But I think the big picture stuff here is that this overhang of his compensation issue is now is gone for now. Mm-hmm. It's going to be still legally sort of has to be worked through in the appeals process. But it seems like even after all this disclosure, after the lawsuit, the voters were informed of what this package entailed at this point, and it seems like potentially a better case for Tesla and Musk right now.
Yeah, Pras, and this is also, I think, very much of a similar type of playbook that we've seen from Elon before, right? Yes, he does have this victory, but then he's also dangling something out in the distance here. When we're talking about those lofty expectations, now he's talking about the fact that he's confident that Tesla could actually reach 25 trillion here in market cap. I mean, putting that into context, is this something that you think all those people in the audience, they are huge Elon believers, is that something that they actually think is realistic? I mean, put some of his lofty expectations and his dreams and hopes that we've heard over the years and how realistic those have actually come, whether or not they've actually come to fruition.
Yeah, I mean, there's been two big things he talked about were robotaxis, and he sort of spilled a little bit of the beans on it, saying that, well, it's going to be a fleet managed by Tesla, and also your cars, personal people's cars that you can rent out in an Airbnb-like fashion with the app. So talking about how that's the future, that's happening. But at the same time, we're not seeing them doing these sort of tests that Waymo is doing, that Cruise was doing with sort of geofenced actual robotaxi pickups. We're not seeing that yet. So that's the next step that I think analysts want to see is, are you guys going to be testing this beyond just FSD on the streets with regular people? Also, Optimus robots, right? That's part of this 25 trillion or whatever plan he's talking about. He thinks that, he said last night, he thinks that there'll be a robot for every person on Earth. So 10 billion robots he's envisioning, which would be trillions of dollars in market cap and business there for them. But again, this robot, we've only seen it in very basic sort of manual descriptions here and what it's been doing. So we haven't seen it actually in work, kind of like in the factory or in someone's house. So that's another big leap of faith that a lot of investors, and from last night, they were very just enthusiastic about Musk and his remaining at Tesla.
Ross, all the best to you as you start saving up for your Supermanium bot. The Tesla bulls are charging. Ooh, a double entendre. Betting big on CEO Elon Musk. Our next guest says that he sees Tesla's valuation north of $1 trillion in 2025. Dan Ives, Wedbush Securities Managing Director and Senior Equity Analyst, joins us now. We might have even had a typo in there. I think you think that this could go even higher here. So ultimately, Dan, let's break that down here. What is your vision for how they can get to your market cap that you're anticipating by 2025?
Yeah, I mean, first off, Brad, this puts that Delaware twilight zone in the rearview mirror. I mean, now with the compact, I think that was a $20, $25 overhang on the stock and now moving to Texas. But when you look at the Tesla story, autonomous FSD, I could argue it's one of the best AI plays in the market when you look out the next 2, 3, 4 years. This is just the start of the next chapter, the next book, as Musk calls it, in the Tesla growth story. I think it's one of the best disruptive names in the world.
Right, Dan. So put some of these lofty expectations then, I think, into a more realistic picture for us. You're very confident that you're going to see, or that we could see, maybe Tesla reach that $1 trillion in value here in 2025. Talk to us about what the catalysts are for that growth, at least in the short term, and then compare that maybe to the longer term picture and some of these longer term believers when it comes to Tesla.
Yeah, so let's walk through the setup. Look, New York City cab driver is expecting a bad June quarter. So no one's expecting great things for June. But I think that's the last tough quarter, tough comp, as then we turn the corner, demand stabilizing in China. And then August 8th, I think, is going to be a historical day. Robotaxis, autonomy, that's kind of the vision. I mean, no different than what we saw from Apple this week in terms of Cupertino and AI. That'll be them unveiling the broader strategy. And then I think you start to then see the execution of the strategy, along with the sub 30K vehicle. We think, I call it a Model 2.5, gets released early next year. In our opinion, the bottom's in Tesla. Bears go into hibernation mode. And I think those thinking that that comp package was going to get voted down had a little too much champagne.
Is Elon Musk too optimistic with his $25 trillion target that he thinks the company can get towards? And what type of company are we talking about at that point? Is it an automotive company? Is it a technology company? Is it an energy company?
Well, look, we've always talked about in the show, this is a disruptive technology company. And I think that's where, look, the bears will say it's a car company. They've said it from, what, 100 million up to $1 trillion. So the point is, this is disruptive tech. And now, when you look at autonomy, software, FSD, that's the vision. But also, this is one that you're going to see 3-4 million vehicles per year when you look out 4 or 5 years from now. And again, betting against Musk, it's been the wrong move. And I think this has clearly been a turbulent period. But I could see that Cinderella story starting again as we go into 2025.
All right, Dan, when we talk about a little bit of a longer term trajectory here for Tesla, we heard lots of talk about Optimus, the robot, and exactly what maybe Elon Musk thinks it's going to do to Tesla's valuation. He was talking about $25 trillion here in valuation. How are you looking at the robot from an analyst perspective and ultimately what that's going to do to Tesla's bottom line?
Yeah, I view it as optionality. Again, in terms of from a valuation perspective, none of that's being valued into the stock. Now, looking out, it's really more about the AI components of it. And we've talked about, I think 3-5 years from now, you will see more and more, we'll call it robotics within consumer households. Well, that's going to be AI driven. And I think that's something that it all goes into this AI revolution. It's not just about Musk and Optimus. It's about the chips from the godfather of AI, Jensen, Nvidia. You're seeing a fourth industrial revolution play out here. Tesla is going to be a main player in that. And I get it. Investors still view it as a car company, but this is just the early stages of broader where Musk is going to be taking Tesla.
How soon do you think Tesla needs to uncloak what a new vehicle model would look like in order to maintain some of the demand generation that we're seeing, or at least in this demand generation cycle, maintain consumer mindshare?
I'd say by March or April 2025. I mean, so this is something I see coming out before the Masters next year, where they could ultimately come out with a strategy, lay it out for a second half delivery, sub 30K. And I think that starts the next phase of the Tesla growth story. And I think Tesla, we look what happened with Apple this week, betting against these disruptive technology companies with massive install base. It's just been, I think it's the wrong move in what we view as a 1995 moment.
Dan, just circling back to where we started the conversation, when it comes to this vote, some of the concerns surrounding Elon Musk over the last couple of years has been that he's been distracted. He has too much going on. When it comes to some of his other companies, and Tesla really requires someone at the helm who's putting all of their focus on Tesla. Are at least some of those concerns valid in your view? And which ones?
Look, Musk is Tesla, Tesla is Musk. And obviously, I'd say most followed human on the world in many ways. A lot of balancing act. Now, I do think there was a phase that he went through where wasn't maybe the pilot on the plane. We talk about the adult in the room. But you're seeing old school Musk return now. And I do think this has reinvigorated him in terms of the vote, the confidence. But you're right. I mean, Tesla's the golden child. They need Musk, but Musk needs Tesla. And I think that continues to really be the focus, especially with AI, I believe, being under the hood of Tesla as the next stage is getting Musk to 25% voting rate.
All right, Dan Ives, always great to talk to you. Thanks so much for making time to join us here this morning. Wedbush Securities Managing Director. Dan, have a great weekend.
You too.
All right, let's take a look at Apple, because Apple taking back the reins as the most valuable company in the U.S. Now, the company closing with a market cap above Microsoft for the first time since January. That happened at the close yesterday. Now, Apple adding $324 billion in market cap over the last 3 trading sessions, according to the latest data out from Dow Jones market data here. When you take a look at where things stand right now, you've got Apple in the lead at $3.28 trillion. Not far behind, you got Microsoft there in the number 2 spot. Nvidia still holding above $3 trillion here, so the race between those three. But I think, Brad, when you take a step back and take a look at the excitement surrounding Apple this week, and really taking a look at that 5-day chart, if we could put it up, because I think that is what's so interesting about this dramatic move that we have seen higher, at least since Tuesday, because we got the update from Apple on Monday. The market's reaction was pretty muted, right? And then after we had about 24 hours or so to digest it, we have seen the stock really take off. And I think that also just explains what is going on in the market here over the last several months. If you are able to convince investors that you are a valid AI play, that you will be among the winners within the AI realm here over the next several years, it's giving investors a reason to buy in here. And I think by looking at some of the gains that we've seen over the last couple trading days, people are confident that Apple is going to be a winner in AI. And in this market, I think you need to, or it really helps if you are able to convince investors of that story and get them on board with maybe what the next several years are going to look like here for the company, and a lot of those gains potentially driven by AI investments.
I mean, this was a critical WWDC for the company. You'd seen year to date coming into May, the company not participating in the broader rally that we had seen in the markets. And that really signals one thing, especially when you have a broader mindset among some of the investors out there and traders out there of this buy on the dip mentality, for Apple to not be participating, even though there was a clear between March and May extended dip that presented opportunities for buying into Apple, and to now just finally get year to date on a positive level as of late May, early June, and now looking at gains really that have been amassed over, in aggregate at least, for the year, amassed largely during June here, it's coming on the back of this company finally saying what it's going to do with generative AI and the optimism of investors that it could show up in some of the consumer technology devices and it be enough to actually spur a super cycle of demand, because they're saying it's only going to be for specific devices that it's going to be leveraged in, at least on the outset here. And so that super cycle, I think, is what a lot of investors are hanging their hat on. That's why you're seeing them finally participating in some of this year-to-date movement higher, and we'll see if Apple can sustain this going forward. But once again, now more valuable than most of the other players out there.
Certainly. All right, let's talk about this rally in tech that we have seen, because it's pushed the NASDAQ, it's pushed the S&P to record highs this week as excitement surrounding artificial intelligence really sweeps Wall Street yet again. The tech sector on track for its best week in about 7 months. For more, we want to bring in John Stolfus. He is Oppenheimer's chief investment strategist. John, it's great to see you again. So talk to me just about how you're looking at this excitement that we're seeing play out in a handful of these tech stock names again, and really what this signals for the broader market moving forward.
Great. Well, Charlie, great to be on Yahoo Finance, speaking with you and Brad today. I have to say, when you look at this, what it really reminds everybody is we're all on the upgrade cycle, because technology is deeply embedded in the lives of both business and consumers. It's not just about phones. If people who have apps for airlines, newspapers, magazines, have recently gotten notice on older phones when they try to upgrade, sorry, your operating system needs to be upgraded, and you find out your old phone or your old computer can't take it. It's time to get back to the electronics store. And probably some of the results that we saw, at least from one company, I can't mention specific names because I manage money, but would indicate that electronic sales are not dead, and we think they're likely to increase. So this all looks like part and parcel of the fact when the genie comes back, when the genie comes out of the bottle, it doesn't go back in, folks.
And so with that in mind, John, not talking specific names, but talking perhaps themes more broadly that we've seen prevail in the markets, how much more legs do you think there is to this trade, especially within generative AI, as we've seen companies who have talked about it on earnings calls or announced some type of product or software update, they've seemed to be the beneficiaries?
Well, we'd have to say, Brad, you know, the old adage of trees don't grow to the sky definitely will step in at some point. But right now, it doesn't appear that technology in this AI story is approaching a level where it's going to stall. It looks like it's still morphing into other things. Essentially, if you don't get onto a plateau, and that's what happened in the tech bubble, is it's sort of plateaued. People were talking about, we're going to have 1 million eyeballs in so many years, but no profitability to them. This is companies that are profitable, that are growing and expanding, and innovation is really taking hold. That said, any catalyst that the bears can find to sell and take profits without FOMO, they'll do it. And, you know, we had that for a while ago. If you think of that company you were just talking about, that's now the largest in market capitalization, the S&P 500, just a few weeks ago, there were a whole bunch of people saying it was done. And it wasn't done at all. It was just ready to morph into the next chapter. So we remain very positive on technology, communication services. We like industrials, but we also like financials. And we think consumer discretionary is desperately oversold this year. If you look at it from the lows of last year, it's still up very nicely, over 20%. So it's just different sectors get haircuts from time to time and pauses. But this appears to be a good time for equity buyers.
So, John, given that you have your year-end target for the S&P is 5,500, and here we are today just above 5,400, what do you need to see in order to raise your target or be convinced? It sounds like you are convinced that maybe the market's heading even higher this year.
Yes, Sean, I would have to say here that, you know, when we came into the year, we were one of the highest on the streets, if not the highest. I think some people say we were the highest. We weren't paying a lot of attention to exactly were we the highest or not. But we came in at 5,200, had to raise it in the first quarter, raised to 5,400. And our discipline is we don't raise our target unless the S&P closes at or above our price target. So it would appear imminent that we'll have to consider whether we're going to raise our target for year end or not, probably over the course of the next few days or next few weeks, depending upon how the market is treated by investors and traders.
And John, as we wrap up this week, it's been heavy on the econ data front. We also had the Fed meeting this week. And one of the top lines here, one of the questions you posed in a recent notice, the multi-trillion-dollar question on policymakers' minds these days, it's are we done yet, or are we at least near done with tightening? So coming off of that meeting, what do you think?
The song remains the same. When Powell came out of that meeting, and the look at the dot plots was still like that was affected by pre-CPI numbers, most likely. But we're still in that period where overall the Fed is cautious before it determines that it will start cutting. It is signaling, it looks like one cut this year. We came into this year thinking when the Fed was saying it was going to go 3, we said, well, perhaps 2 times. And then when everybody was saying 3 to 5 cuts, and some people 5 to 7 and even more, as I recall, because they thought the economy was falling apart, but we don't believe. We thought, probably it may not even happen, but we expected late in the second half, and the November to December, where everybody's looking at these days, looks good to us, and we think the Fed will do it not because it feels the economy is falling into recession or it finds itself in recession, but rather that the Fed feels that it's time to give a down payment to both Main Street and Wall Street to say, look, we can cut. Here's one cut for the beginning of 2025. Relax. And that's really there's a dialogue going on between the Fed and the markets. The market never trusts the Fed. That's typical. But the Fed, since Bernanke has been so communicative, we think it's more advisable that the market listens to the Fed and realizes that the Fed this cycle appears to be our friend.
Yeah, and the added juggling job of seeming apolitical as well along the way. John, a ton of great insights here. Thanks so much for joining us here this morning. Happy Friday to you. John Stoltzfus, who is the Oppenheimer Chief Investment Strategist. Good to see you.
Thanks.
Turning our attention overseas, European stocks falling today, capping off a tough week. The benchmark French index, CAC 40, is off more than 4% this week, heading for its biggest weekly drop since February 2022 as political tensions sour investment and sentiment. This comes after the French President Emmanuel Macron's call earlier this week for a snap election. Here with more, we've got Yahoo Finance's Jared Blickery. My goodness, Jared, parlez-vous français? Take it away.
All right, I'm going to do this one in English if you don't mind. But we do have some international developments on this Friday morning. Let's check out the CAC 40 over in Paris. This is the overnight price action, pretty ugly this week. And as you said, the worst week since, February 2022, worst month since August of 2022. And this has to do with election year dynamics. So let me show you the year to date where the CAC 40 has just now fallen back to the negative territory. So all of these gains have been given back. And I think it's just a good reminder that we do have an election year for a lot of countries, including the U.S. We've already seen turmoil in Mexico and India, and so just more of the same here. Also want to point out separately that over in Tokyo, we do have the Bank of Japan. This is a year-to-date chart. Let me show you the overnight chart. They kept their interest rates on hold. The important thing to take away is they offered no guidance. So they kicked the can to July, and this is causing investors to wonder, well, what's going to happen with the yen? What's going to happen with their bond buying? Are they going to pare that back? We don't know yet, but we do see the yen weakening to the weakest levels in over 30 years. Here is the US dollar versus a basket of different currencies. Greatest versus a Mexican peso right now, but you can see the Japanese yen, let's see, USD, JPY. Well, it's in there, and we did see some modest gains this morning with respect to the yen. And so are we going to see more of that? Well, we'll check out this heat map right here where we have Japanese-based Forex currencies. And here indeed you can see the yen weakening versus the US dollar by about 0.2%. Guys.
Jared, I was so looking forward to this hit this morning that I had a bacon, egg, and cheese on a croissant.
Lovely.
Thank you so much.
With mayonnaise?
Yeah, no.
Okay, good man, good man.
Coming up on the morning brief, the bears are trying to come for Tesla. We'll see if they're successful. We'll talk to one short seller who says the stock could go to $14 a share. Plus, RH is sinking on disappointing earnings. We've got some top trending tickers next.
It's time for some trending tickers. Adobe surging this morning. The company is set for its biggest gain in nearly 4 years. That's if these gains hold right now. Now the company posting better than expected results, raising full year guidance here. We have seen as that reaction play out in real time. You've got shares up just around 15%. When you take a look at that strong demand that the company is seeing, now their AI model, it's called Firefly. They've integrated this into a number of their products, including Photoshop, including Illustrator. Companies saying that renewals are for the more expensive offerings that they're seeing, including that use of the Firefly. But management, I thought this was real key here. In the call yesterday, they said, or in this release, saying that they're still in the early stages of making money from AI, and they're focused on converting the pipeline interest and awareness of AI into monetization. I think that really speaks to some of that excitement that we're seeing play out in the market today, Brad.
I mean, this is such a no-brainer for Adobe to try and figure out how they can insert prompting capacity into so much of their creative elements and the platforms that they do have, and that demand that you're talking about with the AI solutions that they're seeing across all of their customer segments, seeing early success monetizing some of these new AI technologies across digital media, digital experience businesses, and then ultimately here, this is raising their annual digital media net new annual recurring revenue that they're expecting to see. Also, digital experience subscription revenue and EPS targets. So all of these things considered, that's what's factoring into the stock price here today. And I think going forward, as you think about all of the perhaps efficiencies this brings for a lot of digital marketers, a lot of creative professionals out there that can essentially just make sure that they can leverage a prompt in the same platform that they've used for years now to say, all right, generate a picture of a corgi playing with Dogecoin hopping into a lake, and boom, it's done, just like that. I think that's the strength of an Adobe kind of mix of products as well here.
Yeah, exactly. And I think analysts are coming around to that. And I also think that's why we're seeing a lot of the excitement and then the guidance really pointing to that increased demand, even based on what they've seen this past quarter.
All right, we got the opening bell on Wall Street and in Midtown Manhattan at the NASDAQ. We've got Tempest ringing the opening bell there. And at the NYSE, oh man, looks like a great, just family fun environment taking place over there at the NYSE. Love to see it here. All right, so we're going to be keeping a close eye on where things move throughout the rest of today's trading activity. We got a big one here for us today, folks, on this summer Friday, if you will, for those of you that celebrate. Taking a look at the Dow, the S&P 500, and the NASDAQ here. You're seeing some declines across the board. The Dow down by about 0.5%, S&P 500 down by about 0.3%, NASDAQ lower by about 0.25% right now.
We'll see whether or not that downward movement holds. Let's kick it over to Jared Blickery. He has a closer look at some of the movement that we're seeing here at the open. Jared.
Another interesting week, and we're trading in the red to the downside today. And you can see the Dow down about 235 points. Let's check out the week's price action. You can see this is over the last 2 days. We'll do the last 5, and you can see we are down about 1%. I'm going to change this to a line chart, and I'm going to show you what's happening in the NASDAQ. So from minus 1% to almost 3%, NASDAQ has been holding on to some impressive gains throughout the week. And let's remember, this was a huge week of news with CPI and the Fed meeting. And let me just show you another chart. Here's the S&P 500 normal weighted. That's up 1.25% versus equal weighted. That's up only 13 basis points, might even be in the red there. Suffice to say that there is a bifurcation in the market, and this is another week where we've seen a few stocks in a few different industries really leading the way, and that would be chip stocks. We'll get to that in a second. First, here's the 10-year T-note yield. It is down another 2 basis points today, heading towards closer to 4% than 4.5% right now. We've also seen, as those rates are coming down, the increasing chances of a rate cut in the U.S. And here's the dollar going the opposite way, a little bit up. So mixed messages from the bond market and the currency market, but I did note over that we did have that Bank of Japan announcement overseas, and also the weakness in Europe. That's probably translating into some dollar strength today. As you can see, everything in the red here. Let me show you the last 5 days. That's the entire week. Tech and real estate, those are the two outperforming sectors. And I'm going to close with semiconductors. This is what happened this week. You take a look at AMD, okay, that's down 6%, but here's Nvidia. Nvidia down 7%, up 7, Taiwan Semi up 4, Broadcom up 20%, and this stock is just on fire. Let's check out the market cap of this stock, and Broadcom looking like it is 785 billion, so heading up. Not 3.1 trillion like Nvidia, but definitely getting bigger, guys.
All right, Jared, thanks so much. Tracking all things heat maps, where things are moving out of the gate here at the open. Appreciate it. And we're also watching shares of RH. They are, as Alicia Keys would say, fallen in pre-market, and now, as we've begun today's trading session, down by a little more than 13%. The furniture retailer did not meet Wall Street's expectations. RH reported a wider than expected first quarter loss and forecasted second quarter sales that were below estimates here. So there you're taking a look at that decline. I think investors are also trying to wrap their heads around this strategy position right now too. And that repositioning that's taking place in this long-term strategy, they're trying to build the world's first consumer-facing architecture, interior design, and landscape architecture services platform inside of their galleries as well. This also means that they're going to try and conceptualize and sell spaces. So beyond home furnishings, they're looking at and eyeing up this $1.7 trillion North American housing market with the launch of RH Residences. So looking at some of these fully furnished luxury homes, condominiums, apartments with integrated services as well here. So I think investors are just trying to figure out exactly when that'll start to show up in some of the margins for this business.
Yeah, I think that. And I also just think it's also just indicative of the broader macro environment right now. You take a look at the housing market, it certainly has been choppy at best. The macro housing environment is reason, obviously, to be concerned right now and could hinder and weigh on RH's business here in the short term. When you're taking a look at the significance of this drop here, off just about 15%. If that does hold, it's actually the biggest drop that we've seen intraday drop since 2020 here for RH. And because of that, we have seen a number of analysts, because of what we heard on the call last night and these earnings numbers, Bank of America, Wells Fargo, among the analysts that have lowered their target on the stock. And when it comes to the biggest issues here for RH, it's a softening demand, especially in the latter part of the quarter that we are seeing here. Guidance really failing to impress. KeyBank saying that they still see consensus estimates as too bullish due to the economic and competitive environment. So given that setup, there is real reason, at least from an analyst perspective, to be a bit bearish on this name right now, or at least staying on the sidelines. And again, you're looking at a drop of just around 14% today. Well, major indices, they hit all-time highs this week, but we're seeing some of that excitement leave the market today. We got a breakdown for what we are seeing play out in today's trading session and what that signals for the markets moving forward next. Stocks moving lower this morning following a record-setting close for the S&P 500 and also the NASDAQ. We have certainly seen this renewed excitement surrounding a handful of tech names this week, which has really driven the broader markets to those all-time highs. We're seeing some of a give back here in early trading today. So what is the signal that's ahead? We want to bring in Joe Mazzola. He is Charles Schwab's head of trading derivatives strategist. Joe, it's great to see you. So let's talk about where things stand today. We certainly have seen a lot of excitement surrounding AI. That really drove the markets, the broader markets, to record highs this week. How are we set up looking ahead to the second half of the year?
Yeah, well, you talked about the market breadth and what we're seeing there. So you guys talked about bifurcation. I would use another word as well, dispersion. I think they're similar in this context, just because you have a few generals that continue to lead the charge, but underneath the surface, that's not always the case, and especially right now. You know, we're seeing it with our clients and what they're buying. We released our May stacks report, and what we saw that even though there was a slight uptick in the net buys over sells, there was a bit of a churn underneath the surface when it came to the dollar amount. So, you know, when I see something like that, you know, that kind of stands out a little bit. It basically says that there were more net buyers than sellers, but some of the larger accounts started to maybe trim some of those positions. And just like you talk about, tech being the leaders, I mean, our biggest buys for that last month of May were Nvidia, AMD, Tesla, Amazon, Microsoft. So, those are holding strong. But when you're looking at maybe the Mag 7, maybe you need to start talking about the Fab 4, because even within the Mag 7, you're starting to see some of that dispersion.
Yeah, even if they're trimming positions in some of those outperforming names, where's the rotation seem to be into?
Yeah, well, you guys were just talking about RH. I mean, we've seen a decent amount of selling in discretionary, right? So that's where the selling's been discretionary, communications and financials. When we look at the sector level, we didn't see anything that really kind of stood out at the overall level. No, I will say this, though. This is one of those months where we see a little bit of conflicting reports at the millennial level, right? So at the overall client level, we didn't see big buying in any particular sectors, but at the millennial level, that's where we did see some interest. That's where we saw some interest in IT, discretionaries, and healthcare. So we did see some money moving into that. But as I mentioned, it tends to kind of move towards the bigger market cap names. And I think that's going to kind of be the story that we look at going forward until we really see that the Fed is starting to ease its interest rate policy. We got the dot plot this week that talked about maybe one cut this year. That's what they're aiming at right now. So this might be something that carries forward through the summer.
Joe, when do you expect the Fed to cut?
Well, I mean, if you look at what the market participants are saying right now in terms of the Fed funds futures or the CME Fed Watch tool, they're looking at either September or December, potentially one cut. I think we're probably in the September camp. And if that's the case, politics aside, right, I think the Fed is in a position now where they're starting to see some softening data. We're starting to see notwithstanding the non-farm payrolls, which, as we know, is a bit of a laggy indicator. We're starting to see more softness in jobless claims. We're starting to see more softness in new hires. So, that is really the second part of the Fed's mandate is employment. And employment's really starting to kind of, rotate down a little bit. And even some of the soft data that we've seen over the last couple months has started to push down. If you can get the inflation numbers under control, which it seems like right now, at least these last couple data points have shown, we're moving in the right direction. So that's kind of pulling forward that expectation.
Where do you think, and especially as we're considering the timing of when those rate cuts could potentially come forward, I mean, that puts us within the ballpark of when the election is taking place, both on the front end and on the back end there. So how might investor sentiment shift going into that event?
Well, if you want a good indication of that, look at the VIX futures, right? If you look at the VIX futures right now, we're basically around 13 on the front end. Where you see that spike a little bit is in the October future. And that indicates, some indecision around the election results. So, I think one thing to take into consideration when you're looking at the elections, it's not necessarily, what happens in the Oval Office. It's really more what happens in Congress that can kind of push the markets one way or the other. So, I think we get fixated on who's going to be the president, but I think we also need to pay attention to what's happening in the legislative branch as well.
Joe Mazzola, who's the Charles Schwab head trading derivatives strategist. Thanks so much for taking the time this morning, Joe.
Thank you.
Certainly. All your markets action ahead. Stay tuned. You're watching the Morning Brief. Tesla shares fractionally lower, just flat barely to the downside right now, after shareholders reapproved of Elon Musk's multi-billion-dollar pay package. Now the stock is down nearly 30% compared to last year. You're taking a one-year look here, and we're taking a look at the shares over that 52-week period. Our next guest has been shorting the stock since 2020 and sees more risk to the downside for the EV maker. Per Lakander, who is the Clean Energy Transition CEO and Portfolio Manager, here with more. Per, great to have you on the program with us. First and foremost here, how much slippage do you think we could see?
Yeah, thanks for having me. Well, in my view, Tesla is the biggest stock market bubble in world history. And we have just seen the start of it. You see that the models are aged, and valuation is absolutely insane. Earnings are falling off a cliff. I would say they're falling 50% this year. I have like 140 earnings for this year. I think consensus is 265. It was like 5 at the beginning of the year. So if you think of it, $1.50, how do you value that? I think given that there is no growth there, 10 times earnings is very generous. So my price target is $15. Having said that, I think this in the end is going to be a donut because once it gets into those levels, there's so much going on here in terms of class action lawsuits, boards, which is paying itself enormous money, Elon, which is paying itself enormous money. So I think this is hugely dangerous, and in the end, it's going to prove to be the next Enron.
Lots of questions. I guess first, just starting off with some of the concerns that you listed. Those concerns have certainly not caught up to the stock price. And even taking a look at the reaction that we saw from some of Musk's comments last night, there initially was some excitement surrounding the growth, at least that he sees for Tesla over the next several years. I guess my first question to you is, what's going to change the perception here or the minds of investors? Because up until this point, we haven't seen some of those concerns that you've laid out reflected really at all in the stock price.
I would say yes and no. Let's not forget that the stock is down 60% from all-time high at the same time as the market has gone up 20-25% in the meantime. So, but it's step by step. Where what will need to happen here is, of course, that the retail crowd needs to give up, because that is what's holding up this stock. Valuation makes absolutely no sense. Trades on.
Do you think the retail trader, though, will give up on this? And I think that's so interesting, especially surrounding Tesla and that excitement and exactly what that group of investors has been able to do around the broader story here for Tesla.
But everyone runs for the hills when it goes down. So the stock needs to go down. Once it goes down, it's going to go down more. And I think what drives it down is earnings. And I think we are very, very close to the turning point, because so far it's been a slippery slope. They've sold cars poorly, therefore they lowered the price, therefore earnings went down, and it's circulated. Now they are very, very close to ways end here. This quarter, they have really introduced almost 0% interest rates on the cars. When Q2 results come, if you think Q1 had terrible deliveries, but actually not that bad earnings. In Q2, they have done everything to get cars out of the door, and it's gone relatively well. So deliveries are not going to be great, but they're going to be okay. But earnings, 25th of July, are going to be absolutely terrible. There is a chance that the company will be loss-making. And if it's loss-making one quarter and then it's loss-making in Q3, I can guarantee you this is double digits. And then I think many fanboys will run for the hills, and then we are at my 14.
Earlier in the hour, we spoke to Dan Ives, Wedbush Securities analyst and managing director, actually. Here's what he had to say about the EV maker's future. And I want to get your reaction on the other side.
But also, this is one that you're going to see 3-4 million vehicles per year when you look out 4 or 5 years from now. And again, betting against Musk, it's been the wrong move. And I think this has clearly been a turbulent period. but I could see that Cinderella story starting again as we go into 2025.
Now, you are clearly saying that there is a reason to bet against Musk, but it seems like there are a lot of, at least shareholders right now, regardless of whether or not retail is the single proponent that's holding up the stock, that you believe there's reason that you should bet against Musk. As long as Musk is in the helm, does it seem like this is a company that is eventually going to get towards what you've set forth in your own target?
So what I think he's missing is what's going on in the overall EV space. I have to go a step back a bit. We came out of COVID. The auto industry was constrained. There were early buyers of EVs. You made a killing. And Tesla was almost a monopolist, and they made a killing on this. Then when things are very good, of course, everyone piles in. So all the conventional auto producers are piling in, and these models have started to come in 24. More of them are coming in 25. Tesla has nothing. So I'll tell you, there is a true cycle which is playing out in EVs. No one, being battery producer, auto producer, lithium miner, no one is going to make money over the next couple of years. And then Tesla has gone from being the leader to be the laggard. So, you can't have a stock being at 500 billion market cap if you make no earnings. And that's not been the case in the past. So I'm extremely convinced. And, just listen to what GM, Stellantis, Mercedes, whatever are saying on EVs. They don't make any money, and it's going to get way, way worse before it gets better. There's a long story, but that story is for 27, 28.
Per Lakander, who's the Clean Energy Transition CEO and Portfolio Manager. Per, thanks for sharing some of your thoughts here today. Appreciate it.
Thank you.
We've got all your markets action straight ahead. Stay tuned. You're watching The Morning Brief. The vibe on the street today. What are the problems with a hybrid work environment, you may ask? Well, sometimes employees might not actually be working. More than a dozen employees were reportedly let go at Wells Fargo for allegedly using fake keyboard movements to make it seem like they were working. Devices, sometimes known as mouse jigglers, took off during the pandemic work-from-home era, and people swapped tips for using them on social media. Shauna, we can't do this at our job. You got to be on camera and in person. There's no mouse jiggler for that. But I think, actually, there's no but about it. We have to be here. But for people who are working from home and are just required to make sure that that green dot on maybe their instant messaging platform that they use internally or on their Slack just makes it look like they're in front of the computer. It sounds like there were more than one Wells Fargo person doing that.
Yeah, I mean, you got to think, we're 4 years since the pandemic started. If you haven't really done a lot of work, I don't think it's that hard for your boss to figure out if you're just moving the keyboard, if you're just pressing numbers on the keyboard, if you're just trying to move your mouse around every so often throughout the day versus doing actual work. So I think that maybe this was used in support, if it was, to let some of these employees go. But I think just this points to some of the difficulty that these firms are having in monitoring their workers from home. There is this push-pull with some employees. They don't want to go back to the office, and not just within the banking sector, across sectors. They don't want to go back to the office. They love the new flexibility that they have been grown accustomed to because of the pandemic. But we have seen more and more managers come out and executives mandating this return to office. And I think a lot of it, one, obviously has to do with culture, but two, just making sure that people are getting their work done and are making great use of their time. So I think that's why this has been so controversial. But again, if you're not doing your work and you're maybe potentially ordering one of those things off of Amazon that's going to move your mouse around every couple of minutes, hopefully their bosses are figuring this out pretty quickly, because it doesn't seem too difficult to me.
I mean, they're going to very quickly figure out that this is perhaps an expendable role. If you can have a mouse jiggler that just makes it look like you're continuing to be online without actually turning in any assignments or contributing to any projects or things of that nature, then that makes it look like that role is not necessarily necessary to the operation.
Certainly not those roles. All right, well, coming up, we have breaking consumer sentiment data at the top of the hour. We are going to discuss the state of the consumer, what it means for the economy, all that and more on Catalyst next. It's 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills, and let's dive into the catalyst moving markets today.
Consumer sentiment is crossing the wires now. We're going to give you those numbers and break down what the data means for the economy and the Fed in just a few moments here.
And the next big catalyst for Tesla could be its Optimus robots. Elon Musk is saying at the company's annual shareholder meeting that the humanoid robots could lift the company's market cap to $25 trillion. Could this maybe sway the Tesla bears? We're going to discuss.
Plus, taking a look at the global picture here, European stocks falling, with French equities and bonds taking quite a battering this week as President Macron attempts to hold on to his power. Over in Japan, the Nikkei closed higher after their central bank kept rates unchanged. We're going to dive into how global markets could be impacting your portfolio.
All right, first we want to get to some breaking news that we have out on consumer sentiment coming in below expectations, falling to 65.6 versus the prior month's reading of 69.1. Putting this into context here for you, it's actually the lowest consumer sentiment index reading that we have seen since November. And digging into this report just a bit, the expected change in median prices during the next year, that was actually unchanged at 3.3%. The expected change in median prices during the next 5 to 10 years, that actually rose to 3.1%. So some concerns about rising prices, inflation clearly coming through within this print. But again, consumer sentiment, University of Michigan, the prelim reading here of the survey for June falling to 65.6 here, Maddie, versus 69.1 last month for the reading.
It's really interesting to see this kind of softness because we're seeing that wage growth is continuing to keep pace with inflation, and that is one of the key drivers of consumer sentiment. So interesting to see this. Having said that, though, when you think about the falling consumer sentiment and what the consumer is feeling about the economy, you have to wonder what so many of our guests have been saying. Mohamed El-Arian making the great points about this yesterday, this idea of a K-shaped recovery, and when part of the economy is starting to feel really negatively about it, could weigh on the broader picture. And in here, we're starting to see some evidence of that softening view moving forward.
Yeah, and I also think this just points back to the fact that obviously consumer is such an important part of the economy, being a prop of the economy. We talk about the spending, we talk about the fact that the consumer has remained extremely resilient, much more resilient than many forecasters had anticipated up until this point. So any sort of softening within that, I think, also begs the question maybe if whether or not it signals broader weakening here down the road, or really maybe a change literally in sentiment amongst consumers at this point, given some of the latest data points that we had seen here over the last several weeks.
Yeah, just taking a look, we are seeing a little bit more movement to the downside in the 10-year, just seeing some more of that in the bond space. We're also continuing to see the movement to the downside in the broader market, but that was already happening prior to this data this morning. So moving forward here, after that lower than expected consumer sentiment reading, we are seeing these stocks continuing to move to the downside after a big week of inflation data showing inflation pressures easing back in some categories. We also saw an uptick in jobless claims. So what can we expect for the economy moving forward? Joining us to discuss, we've got Bob Arnott, Research Affiliates founder and chairman. Bob, thank you so much for, thank you so much for being here with us. So I want to talk about your reaction to these consumer sentiment numbers that we are getting in here and how it kind of relates to the totality of the data, not to sound like Jay Powell, that we've gotten this week. Does this change your overall thesis at all?
No, not really. We love finding asymmetries in risk, and consensus about the economy, about the markets, is usually largely correct, but it's pretty useless because it's already baked into the price, 100% reflected in share prices. So the way to win is to ask where the consensus might be wrong. Consensus expectations suggest a mild softening of growth and a gradual last mile in the easing of inflation. Is that possible? Of course it is, but the risks are asymmetric. Most would agree that the economic growth is more likely to surprise to the downside, and inflation is more likely to surprise to the upside. We look at the economy and see PMI in inventories, yield curve slope, and three-year trend in cost of capital. They're all strong predictors of slowdown or recession. All four are in their worst quartile ever. The latter two are in their worst decile ever. So the only thing sustaining current economic growth is a wealth effect from the bull market and consumer spending. The asymmetries of risk are that the economy can do much worse than consensus far more easily than it can do much better than consensus.
So, Rob, I guess given those concerns, then first, just talk to me about the downside that you potentially see as a result of all that. What do you think that looks like, and what should investors then potentially be waiting for if you don't think now it doesn't sound like is the right time to buy?
Well, we can watch for shocks this year on the economy, more likely on the downside than the upside, on inflation, more likely on the upside than the downside. On geopolitics is fraught many places around the world. I don't think the risks to Taiwan are totally off the table for this year. It's not impossible President Xi decides I'll never have a better chance to take Taiwan with the US so thoroughly distracted. None of these things are in current pricing. Domestic politics has been fraught, to say the least, and is not going to get any nicer or any tidier between now and November. So there will be great buying opportunities in the next couple of years. This is not one of them.
Okay, well, it's interesting because you have this idea, yes, you want to bet against consensus. That's how you find an edge, of course. But you've got the top 5 names driving 80% of the gains in the market this year. Explain to me how you make money with that viewpoint, right? If the top 5 names are going to be driving the majority of the gains, how can you afford to bet against consensus when there is this much concentration?
Well, you should definitely bet on those top 5 names as long as you have some sort of crystal ball that tells you when to get out.
Okay, well, tell me what the crystal ball is. Do you have a take? I mean,
bubbles persist until they don't. I've written a lot about bubbles over the years, and we developed a definition for bubble that you can use in real time back in 2018. And that definition is that you have to use implausible, not impossible, but implausible assumptions to justify the current share price of an asset or of a market in a discounted cash flow or other valuation model. And the second confirming part of the definition is that the marginal buyer doesn't care about valuation models. Nvidia is a fabulous company with enormous profits, enormous growth, enormous potential, but it's priced at over 40 times sales. Now, yes, sales are doubling this year versus last year, so it's 20 times next year's sales. That's still an enormous multiple of sales. Tesla, you've been talking about lately. Firstly, as for the shareholder vote, I enthusiastically endorse the notion that a deal is a deal and that the Chancery Court had absolutely no right to void something that was voted on by shareholders and that paid off massively for Elon Musk in a context where he delivered the goods. He delivered spectacular growth, and he earned that payoff. So I support the vote, but the share price is, as your last panelist or last discussant said, the share price is a massive multiple to sales and profit. So we're looking at bubbly behavior. Now, bubbles don't necessarily mean that the growth is impossible. Can one of these companies turn out to grow sufficiently to justify astronomical multiples? Yeah, it can happen. But the likelihood of all of them continuing to deliver is slim to none. The top of the dot-com bubble, the 10 most valuable tech stocks in the world in the year 2000, how many of them had beat the S&P over the next 15 years? 0. Not one of them. How many beat the S&P over the next 20 years? 1, Microsoft. That's it. So when you get to frothy, bubbly behavior, it's time to be careful. I'm not saying short these stocks. Shorting a bubble is very dangerous because bubbles can go longer and further than you can possibly imagine.
So, Rob, I guess my question then is, what happens next? What should investors do if they are invested in some of these names? It sounds like it's not just maybe those at the top that we're just seeing that bubble-like behavior. How do people protect themselves then? And what do you think is going to be that catalyst? I have a lot of questions here. What is going to be that catalyst that is going to cause that bubble then to potentially burst?
Well, consumer spending faltering can take a lot of froth out of the market. Markets move based on liquidity. And so if liquidity is withdrawn from the system, that can do damage. If inflation exceeds expectations to the upside, we're not saying that inflation is going to go crazy anytime soon, but we're not saying that risk is totally off the table because our policies out of Washington, D.C. are reckless. So when it comes to what investors should do, if you have heavy exposure to these stocks, what's the harm in taking your initial investment out and play with house money? That's a very, very simple expedient that can make a lot of sense. Where should you invest? Non-US stocks are cheap for obvious reasons. Things get cheap for a reason. But those reasons can change too. The asymmetries of risk with European stocks and emerging market stocks are to the upside, not the downside. And so we see lots of opportunity for investing outside the US and outside of the tech sector. I've been called a perma bear at times. I'm not a bear when things are cheap. And there's a lot of cheap things out there. They just aren't the so-called Magnificent Seven. And by the way, whoever coined the expression Magnificent Seven obviously didn't see the movie. 4 of the 7 are dead at the end of the movie.
Well, you know, there's still a lot of people that are trying to take credit for coining the Mag 7 term. Rob Arnott, it was great to have you. Thank you so much for taking the time to join us in Yahoo Finance. We hope to have you back.
Thanks a lot.
All right, let's talk about Tesla because shares here moving not too far from the flat line. Now they're actually off just about 2%, so a reversal here from earlier action after shareholders approved Elon Musk's pay package yesterday afternoon. At the meeting, Musk also predicted that Tesla's Optimus robots could eventually lift the company's market cap maybe all the way to $25 trillion. For more, I want to bring in George Gianarikas. He is Canaccord Genuity's managing director. George, it's great to have you. So first, just your reaction to not only the approval, but really more so those lofty expectations and goals that we saw laid out from Musk last night.
Yeah, good morning. Thanks for having me. So first on the shareholder meeting, we were very encouraged that shareholders approved the previously approved pay package. You know, obviously Elon Musk is critical to the success of Tesla in the past and in the future. He did make several comments that you alluded to regarding the future of robotics, the future of AI through full self-driving. And we're very bullish on the long-term prospects of full self-driving, and we're bullish on robotics. It's just not something that, at least from a robotics perspective, we see impacting our estimates anytime soon. Now, as it relates to full self-driving, we're very, very bullish on the medium to long-term prospects. And what we need to hear more about, you know, in the near term and on the conference call is what take rates are. If you recall, Tesla recently reduced the price of its full self-driving software. If you buy the annual subscription, it's come down to $99 a month. And we really need to hear how our consumers are reacting to that, because that is really going to drive our earnings estimates over the next several years.
Talk to me, George, about what you'll be looking at to suss out what you just mentioned. I was really interested in your note that you commented on the potential for a Tesla to start looking like an AWS when it comes to full self-driving. If you saw more R&D into something like chips, for example, would that be an indication to you that that is an area of more growth potential for the firm?
Yeah, so Elon Musk talked about leveraging the inference compute on some of the full self-driving ready vehicles long-term to create something that looks like AWS that he can then sell and create a revenue stream around. That's probably going to impact the P&L, 2030 and beyond is our guess. But in the very near term, like I said, leveraging the AI that he's created within Tesla, the real world AI around full self-driving, really will drive the P&L to the extent people adopt it. Do people want to buy the service that enables their vehicles to drive themselves? That's super critical. And we think it's going to be a really important driver over the medium to long term. But in the near term, are people reacting to the price cuts that they got and that 1 month free service that he enacted a couple of months ago? That's very important to the near term of the firm. And with regard to near-term sales, now something really interesting that he said towards the end of the conversation, it was 2 hours long, was that there's still, it's tough sledding out there for EVs, and that they still expect year-over-year growth. What's interesting about Tesla stock at this moment, it's clearly been an underperformer relative to the other Mag 7 over the last, call it 12 to 18 months. And what's driven that is earnings revisions, right? Ultimately, what drives stocks are earnings revisions. And those earnings revisions have come in place because EV sales have been sort of weak across the world, including for Tesla, and their margins have been dramatically impacted. Now, what could happen from here is that those earnings revisions may at least stop going down and may start inflecting upward. So even though it's tough for EVs, it continues to be tough for EVs, if they can grow year over year, and we have 3% year over year growth in units, that's probably better than most people think. And that earnings inflection will be super important to the near to medium term performance of the stock.
George, I'm curious, how do you view Tesla? Where are they positioned in this AI play story? Because we heard from Musk last night. He by far thinks that Tesla is leading this race. Do you agree?
Look, they are in an incredibly enviable position relative to other companies for real world AI. And what real world AI means for us in the near term is full self-driving, maybe long term, moving robots around. The other companies that we're very excited about in real world AI are companies like Mobileye that are enabling other vehicles to drive themselves, and a company called Aurora, ticker symbol AUR, that's enabling Class 8 vehicles to drive themselves, hopefully starting at the end of this year. So they're clearly in a leadership position. There are other companies that are vying for that leadership position, including Mobileye in passenger, and Aurora in trucking. And we think we're incredibly bullish, like I said, about the medium to long term of full self-driving for Tesla. We just really need to hear about those take rates and how consumers have reacted to that price cut.
How much does Optimus play into the idea of Tesla as an AI play moving forward? And obviously Musk seeing that they could earn $1 trillion a year from bots. You mentioned that is probably a little bit further off, but do you think that is a reality?
Yeah, I mean, look, he said yesterday that for every human on Earth, we're likely to have 2 robots per person, right? So that's, in the tens of billions. I admire him quite a bit. He's accomplished many things, and to his own credit, he said that being optimistic, irrationally optimistic, has led to the construction of a massive factory in Texas and to this behemoth that we call Tesla and SpaceX. We don't have optimism in our numbers anytime soon. We'll see. I mean, they said on yesterday's event that they'll have 1,000 humanoid robots next year, plus working at the Tesla factory. Clearly amazing, not so impactful on the P&L. It's something that is very important for the story. We'd call it, 5 to 10 years out. We're not so sure that it impacts the P&L anytime soon.
All right, George, thank you so much for joining us. We really appreciate it. That was George Gianarikas, Canaccord Genuity Managing Director. Thank you so much, George, for being here with us.
Thank you.
Now coming up, we've got our trending tickers. On the other side of this break, we're going to be watching Boeing, Stellantis, and GameStop next. Let's take a look at some trending tickers that we are watching on this Friday morning, starting with shares of Boeing moving to the downside, down just over 1.5% after the company announcing it was investigating a quality problem with its undelivered 787 Dreamliner planes. Boeing said it's, quote, taking the time necessary to ensure all airplanes meet delivery standards prior to delivery. Now, Shauna, as you know, this is coming amid a slew of issues for the company. The FAA is also probing the 787's quality defect, according to the agency. The FAA has several investigations ongoing into this company right now, and the FAA chief, Michael Whitaker, saying at a Senate hearing that this is just, again, one of several of those investigations, seeing that you can expect to see an increase in reports when you have a place for employees to kind of speak up, and that's exactly what we are seeing when it comes to Boeing. But as we were just talking about, this is an issue with the fastener, and that is not the same manufacturing issue that we have heard previously from Boeing. So it indicates that there are more problems potentially under the hood that we're going to continue to be hearing about.
Yeah, this is just the latest in a string of many issues that Boeing is facing, and we're seeing the nervousness here of investors when we do get news like this. You're looking at shares off just around 1.5%. But when it comes to this issue, let's put it in context for everyone out there, because the company here discovering hundreds of fasteners have been incorrectly installed on the fuselages of some of those undelivered jets. So I read that line and I said, what the heck is our fasteners, and what does this mean, and how significant could that problem be? And taking that just a step further, so there were some issues with the tightening here of these fasteners, and the Boeing plan of more than 900 fasteners per plane split equally between both sides of the jet's mid-body. So number of these fasteners per plane. There are some issues about whether or not they were tightened correctly. So this could be a huge issue here for Boeing, at least here in the near term. Again, these are 4 planes that have not yet been delivered. So Boeing now investigating this here. It's a quality problem, the latest quality problem that Boeing now faces here, this time with those undelivered 787s. All right, let's take a look at Stellantis. Shares are falling this morning after the car maker saying that it would shift production of some electric vehicles away from China due to new European Union tariffs. Now, the tariffs are scheduled to start just next month, July 6th, and they're a result of an EU investigation into potential unfair subsidies for Chinese EV makers. Now, we're seeing Stellantis shares off nearly 5% here in early trading. And this is just the latest move. I think when it comes to the movement here, or moving some EV production out of China, for investors and analysts, the questions that they're asking is how quickly can that be done? How realistic? What is that going to do to cost? Is that something that will potentially hurt their margins down the line? What is Stellantis, if anything, what can they do to maybe offset some of those increased costs, if in fact that is an issue? So again, this is just another potential problem here, or risk, I guess, associated with this stock, coupled with the fact that EV demand clearly not living up to those expectations, and that overall has already been an overhang on Stellantis and many of its competitors up until this point.
And that is exactly what the CEO talked about on their investor day. Basically, this idea that you can only be so defensive with your balance sheet in terms of cost cutting. At a certain point, you got to start bringing in the money. The CEO saying that he aimed to correct, quote, arrogant mistakes. He said they had a convergence of 3 big issues that he should have started an immediate task force to address. And he said, quote, when I'm saying that you're arrogant, I'm talking about myself. So really taking some accountability for the challenges that we've seen in the stock. Not the worst year-to-date performance, and certainly not the worst over the past year in particular. They're down about 7% in Milan trading over the past year. So it's certainly not been a horrific performance over there. They're looking year to date here stateside, it is looking a little bit worse, down 14%, but certainly experiencing some of the broader headwinds that EV makers and car makers in general have been experiencing here as well. And finally, we have to end our week by talking about GameStop. Keith Gill, known as Roaring Kitty, he seemed to increase his ownership in GameStop common stock, now appears to be holding more than 9 million shares. He posted a new screenshot of his E-Trade portfolio on Reddit's Superstrong forum after the bell yesterday. Shares today are moving to the downside. They're down just flipping over 2% here, but it's interesting that this post seemed to be the biggest catalyst for the movement that we're seeing in this stock to the downside, but he still continues to be one of the top 4 holders of GME. The others are, I think, Vanguard is among them, BlackRock as well. So he's certainly the biggest individual investor. It's not necessarily a bearish signal for the people who love Keith Gill. but we're still seeing moves to the downside.
Yeah, again, his portfolio no longer showing or no longer including the 120,000 call options. And then those were set to expire next week. So I don't necessarily think that's huge surprise here to many on the street. He remains invested, it seems like, at least to GameStop, really backing what he has said, or what he has signaled, I should say, through his social media outlets over the last several weeks. So again, we are seeing some movement here to the downside from GameStop, but this is a stock, clearly it's been on quite a wild ride here over the last several weeks, ever since we did have Keith Gill return to social media for the first time, reigniting some of that excitement, reigniting certainly his fan base surrounding GameStop. And you can see that on that year-to-date chart on the right half of the screen ever since the middle of May, when we have certainly been on the up and down path here over the last several weeks.
It's hilarious. The stock was at $50 in May. Now it's down to 28. Earlier in May it was at 11. It's just totally all over the place.
Make your head spin.
Yeah.
It's made our head spin.
Total wild ride here. All right, we're going to have more of your markets action ahead right here on Yahoo Finance, so stay tuned for more. You're watching Catalyst.
The Fed holding rate steady this week, now only signaling one cut before the end of the year. The equity market still digesting that latest commentary. Our next guest saying that the credit market is in more of a holding pattern, and the loan market could soon maybe be due for repricing. Let's talk about it, where the investment opportunity is. We've got Michael Anderson. He's Citigroup's head of U.S. credit strategy. Michael, it's great to see you. So let's first just take a step back. When we take a look at what we heard from the Fed this week, that lack of reaction maybe that we saw play out in the credit market, what do you attribute that to?
Yeah, a lot of it is just due to the fact that the markets have tightened a lot. There isn't a lot of upside in either the high yield or the loan market. So if you think about the high yield markets in terms of spread, the spread has been locked around 300 basis points in a very narrow range for the last 3 or 4 months. And of course, we've seen a lot of volatility in recent years. And then on the loan side, loans are floating rate assets. They are also callable at par generally very quickly after new issue. And so with the vast majority of the loan market trading above par, there isn't a whole lot more that it can go up. So risky assets generally were cheered by the inflation news and to some extent the Fed. But for the most part, credit right now there just isn't a lot of upside to participate in a rally.
So then, Michael, what questions are you getting from clients specifically regarding kind of the path to rate cuts as it does start to become a little bit clearer? What are they asking you about next moves and potential catalysts in the credit space?
Yeah, I mean, well, first on the Fed side, our econ team is expecting the Fed to cut in September and then to continue to cut in successive meetings after that. They are definitely more bearish than the street is on the economy. So that's going to drive sort of the Fed policy. But as far as the credit markets are concerned, it's more of a fundamental story. These are asset classes that trade at a spread over treasuries, and those spreads are very tight right now, as I mentioned before. I'd say that the real question is when the Fed cuts rates, why are they cutting rates? Are they cutting rates because we're heading into a recession? And we've certainly seen some softening of data, particularly in the labor market recently. So there are good reasons to be watching that very, very carefully. Or are they cutting rates because you have this, what economists call immaculate disinflation, and that you get the soft landing, and that the Fed is able to cut rates on their own, and then that hopefully that will further ease financial conditions for companies and compel more investors to come into our asset classes.
Mike, I want to go back to what you just said a moment ago when we were talking about the loan market here. It could be in for a sustained repricing wave. There's also something you mentioned here in your notes. I guess more specifically, why? What would be driving that? And ultimately, then what do investors need to be prepared for or know about the impact that that's going to have?
Yeah, it's a great question. To just take a step back, as I mentioned, spreads are very, very tight. And so why are we in this situation where it's good to be a borrower, it's good to be an issuer? Right now, companies have multiple channels that they can access capital. The private credit markets have grown a lot, and so therefore they have quote unquote stolen some share from the broadly syndicated markets that we are talking about here. And so in order to compete, the broadly syndicated loan market and the bond markets are trying to be a little bit more issuer friendly. And actually you've seen our markets shrink a little bit. So that's also supported the technical. The loan market has peaked out at about 1.4 trillion in size. The high yield market shrunk by about 15%. So when there's more demand for credit assets, they're sort of chasing the same amount of paper and driving valuations higher. So that's sort of the backdrop. And you're not seeing a lot of new supply. Where would we normally get new supply? Well, often would come in the form of LBOs. But of course, the Fed has hiked rates, and the Fed has made debt more expensive. So it's made buying companies and levering them up a little less attractive for sponsors. So we are operating in an environment of really a lack of paper. And so going back to the loan market, that has driven prices. It's about 70%. We estimate about 70% of the loan market is trading above par. And so when you look at, we've already seen a lot of repricings. May was a record month for repricings for the market. Got close to 100 billion of the market reprice. Gotten close to 20% of the market has already repriced this year. But there's a couple of things that you're saying. Number one is some of the companies that repriced back in January are now coming back in and looking to reprice again. And often they're actually able to cut more this time than they did back in January. Number two is you look at the margins in the market. Issuers are still paying a fairly high margin relative to history. If you look back to 2017, 2018, the last time that we had a very lengthy and extended repricing wave, margins came in a lot. They came in by about 60 basis points from 360 to 300. Right now, we're close to 340. So it tells you there's scope on that side. And then finally, with loans or floating rate assets, they float off of short-term SOFR. And so that means that right now, overall yields still look very attractive. And even if the Fed cuts 25, 50, 100 basis points, they still are very attractive from a spread, from an overall yield basis, and competitive to other asset classes like investment grade credit or high yield credit. So a lot of those tailwinds are in place for an extended repricing wave. The big question is going to be the fundamental backdrop and whether or not we're still headed for that soft landing, or some of the warning signs that we've seen recently are exactly that, warning signs that things could get worse.
Michael, in our final minute, I want to end on what you mentioned there about valuations. Can you talk a little bit more about what you're seeing under the hood with regards to what's sort of keeping valuations tight, and why you're not necessarily seeing a broader picture there of what the movement could look like moving forward?
Yeah, that's a big issue right now because the average, so when people talk about the spread on the high yield market, they're talking about an average, but of course there's a distribution around that average. And so if you break the market down into the tightest to the widest names, the tightest names basically trade on top of, the tightest 80% of the market trades basically where it did in May 07, which was the all-time record tight. It's the distress segment, which includes some communications names. That's a sector that, despite the fact that the growth has been resilient this year, it's still a sector that's quickly evolving and trades at a fairly wide spread. So when you look at it, look about the distribution, the reason why spreads don't even look even tighter than they are right now is because of this stubbornly wide tail. And some of those names might be heading to restructuring. So the spread may not be as meaningful for investors in terms of being able to capture that spread because it might be more of a restructuring situation.
All right, Michael, we're going to have to leave it there. Thank you so much for joining us. We really appreciate it. That was Michael Anderson. He is Citigroup's head U.S. credit strategy. Really appreciate it. Now coming up, Japan's Nikkei index closing higher after the BOJ making a critical policy decision, but leaving some question marks for investors. We're going to dive into that next.
Let's take a look at where markets are trading. We're just around an hour and 10 minutes into the trading day. We want to draw your attention to the selling pressure that we are seeing really across the board. Now you've got the Dow off just over 300 points. You have the S&P off about 0.5%. We are just off the intraday lows for the S&P. The NASDAQ also moving to the downside here, off just about 0.2%. When you take a look at some of the individual sector action that we are seeing, industrial sector here extending the declines here that we started to see shortly after the open. Right now, we have the industrial sector eyeing the worst day that we've seen since October. The Dow right now heading for its worst day since the end of May 31st. So again, some selling following yesterday's, or really the risk-on sentiment almost that we've had for much of this week, where we also had a couple of the major averages, the NASDAQ and the S&P 500 ending yesterday at record highs. So a bit of a give back here in early trading, Maddie.
Yeah, a bit of a give back. I remember yesterday when we saw stocks kind of flipping to the downside, we were all like, well, why are they down? And I remember what Steve Sosnick always tells me, you should be asking, why are they up, right? In this market, it's a very thin line between what they're going to be happy about with the data and what's going to signal, oh no, the Fed cut it too tight. They aren't cutting rates back fast enough. We're going to see some looseness in the economy, perhaps the sentiment numbers weighing on that picture. But again, markets were already sort of moving to the downside prior to that. So potentially also just heading into the end of the week here, a little bit of profit taking happening as well. All right, moving forward here, the Nikkei closing higher after the Bank of Japan kept its benchmark interest rate unchanged while indicating it's considering reducing its purchase of Japanese government bonds, but leaving a lot of question marks about what that's going to look like. Here with his outlook for Japanese equities, we've got Evan Tyndall, founder and chief investment officer of Bearish Capital. Thank you so much for joining us this morning, Evan. I appreciate it. So you have 40% of your assets invested in Japanese mid to small caps, which I'm fascinated in. For a U.S. audience of retail investors, explain to me how the movements from the BOJ are playing into your broader investment thesis and what that might look like.
Yeah, I mean, honestly, my biggest advice for retail investors and investors generally is to pay less attention to quarter to quarter moves by the Bank of Japan or any central bank, and really focus on the valuation of companies and how the corporate governance is changing or improving in a given market, and that's where we see the biggest opportunity in Japan.
Yeah, Evan, I guess if you could speak a little bit more about this, just the fact that we didn't really get any details or a specific timeline, is that something that's going to likely keep the market there, I guess, a bit volatile until we get more clarity?
Yeah, possibly. I mean, you see across the world short-term traders kind of focusing on the machinations of, in the US, the Fed, and in Japan, it's the Bank of Japan. I mean, I think over a longer term period, with Japanese inflation sort of consistently at the 2-3-4% level, sort of similar to what we have in the US, I think they're likely to normalize rates over a longer period of time. And, but it doesn't change the fact that we still see pretty big opportunities in Japanese stocks, more from just the undervaluation of them rather than any sort of dependence on interest rate moves.
So, Evan, the show's called Catalyst, and I almost feel like this is the perfect reason or place to use the word catalyst. Because my question to you is, what is going to trigger that upside move? When you talk about this bull market, a reason to be optimistic here in Japanese equities, what's driving that, or what will be the driver of that?
So, ever since Abe came out with corporate governance reforms in 2014, there's been sort of a growing movement for Japanese companies to care about shareholders, really. But the stock market has really done nothing. I mean, you look over a 30-year period, and the Topix, had a 2% annual return up until the end of 2023. But under the hood, we see companies with more independent directors, more buybacks, more dividends, and just an increased responsiveness to shareholders in general. Not to mention increased responsiveness to stock prices. Like there was an article in the Financial Times a few months ago where these days companies whose stock trade at below book value have to, when they see the head of the Tokyo Stock Exchange on the golf course, they have to actually apologize to him for how poorly their stocks are doing. And that just kind of speaks to the increased concern that management teams have about stock market valuation. So the catalyst is buyback, dividends, and actually eventually opening up of the market for corporate control, which is kind of code for private equity firms. I mean, you just aren't going to have a whole swath of companies trading at 7-8 times EBIT for a long period of time if private equity firms are allowed to come in and buy them up. And you see just this week, Blackstone announced a tripling of their Japanese deal making to about $10 billion. So we think that could be a big catalyst going forward.
Well, I'm interested in, I love the golf course example, that's hilarious, but I am interested also in whether or not the BOJ is kind of over-focusing on the inflation picture here in the US, because there are two very distinct groups of challenges between the two central banks. Do you have a sense that the BOJ is over-focusing on US data, and is that a potential headwind for your thesis?
No, I don't think so. I mean, Japanese inflation data is, I think roughly similar, 2, 3, 4%. I think over the long term, like differences with that in the U.S. data is not going to really impact. I mean, when you're buying stocks, you're buying a stream of earnings that's 5, 10, 20 years out, even though everyone likes to, sort of focus on the quarter to quarter moves in interest rates. We think the more fundamental change in Japan is not any moves in interest rates, but is these changes to corporate governance and sort of the entry of global private equity firms that are really going to drive the stock market forward, and is independent from anything that's happening in the U.S.
Evan, I want to switch gears a little bit because Tesla and Apple have both had very big weeks here. You are shorting both of those stocks, and you're also shorting AMD. I feel like we always talk to you about your contrarian calls, and I'm curious about how you're finding success amongst these contrarian calls and how you're able to kind of withstand the upside that you're seeing in these names and maintain that call.
Yeah, it's been a very difficult period for shorting any stocks. We think it's been difficult for us this year so far. We're down a bit on the year, but for us, it kind of rhymes with the 2021 period where, of course, you had the SPAC craze, and we also outperformed or underperformed significantly during that period. But we all kind of know what happened there, right? I mean, the growing valuations or overvaluations in our view of some of these stocks in 2021 contributed to huge underperformance of the Nasdaq and other sort of growth names in 2022, which allowed us to outperform by around 50%. We're sort of skeptical that the AI replacement cycle at Apple can really drive $300 billion of value. And the other thing we're skeptical of is, anytime, as Apple's AI moves drive potentially more searches to Siri rather than Safari, we think it might endanger the Google $20 billion annuity that Google pays to be the default search engine on Safari. So we feel like that's kind of underappreciated by Apple investors right now.
All right, Evan, we always appreciate your contrarian calls. Thanks so much for joining us here this morning, walking us through this. Evan Tindell. We hope you have a great weekend. Have you back soon.
Thanks.
All right, keep right here on Yahoo Finance. We got much more of your market action ahead. Stay tuned. You're watching Catalyst.
GLP-1 drugs like Ozempic, Mounjaro, and Zepbound have been huge cash generators for their manufacturers, with Eli Lilly, the maker of Mounjaro and Zepbound, reporting $5 billion in revenue last year from just the two diabetes and weight loss drugs alone. But what are their competitors doing to catch up as the research and technology enters its next phase? For more on this, we bring in Salveen Richter, Goldman Sachs' U.S. lead biotech analyst. Salveen, great to speak with you, and thank you so much for being here. I know that you just got back from this conference, and it's interesting because we constantly have guests coming on saying the healthcare space, it's so defensive. I wonder from your perspective and some of the conversations that you had this week, how much is the weight loss drugs of it all playing into that trade?
Sure. Thanks for hosting me. Really nice to be here. And we did just come off our Goldman Sachs Healthcare Conference in Miami. So I think there is a defensive nature, clearly, but there's also macro dynamics that have been playing out this year. The weight loss dynamic that's happening and the theme that's happening is probably one of the biggest we've ever seen for the sector. We just came out with $130 billion as the total addressable market that we're looking at. And very much there's been a duopoly situation via Lilly and Novo. And there was a lot of commentary at the conference about how to think about these next generation options that are coming in that are looking at improving upon efficacy, upon tolerability, as well as the ability to deliver in a different way, such as an oral versus an injectable. Sure. And then finally, maintenance. Because if this is going to be a chronic disease, you want to be able to, manage through a long time period. And then there's people looking at quality of weight loss, such as the muscle loss.
So, Sylvain, I guess the question is, after Eli Lilly, after Novo Nordisk, when you kind of get down to some of those players that are now entering the space or see that real opportunity, who should or what should investors be considering when they are trying to get some exposure into that excitement?
So the third company that's likely to enter is Zealand, which is based out of Europe. The fourth is likely Amgen, and they will show us their phase 2 data by year end at a once a month to once every 3 months injectable, potentially with a differentiated approach. And then we're watching Regeneron as a player going after the quality or body proportionality of weight loss, meaning right now when you lose weight, about 40% of that's coming from muscle. So they're trying to address that side of the story.
I know that you don't cover this name specifically, but just as an example, the Him and Hers Health company kind of offering their own compounded version, which is not FDA approved. But I am curious to what extent you think that could be a headwind for the FDA approved names as people just start buying the compounded versions that are a little bit more accessible. They don't need as much clinical approval. Is that a potential headwind for the companies that are selling FDA approved drugs?
I think that's coming into debate right now because there's limited supply, right? There's significant demand, and you've heard Lilly and Novo talk about how many plants they would have to build to be able to address the supply. So I think when we start to see them expand on manufacturing, but also these new entrants coming in who have manufacturing capacity, like Amgen talked about at length about their ability to manufacture here, that should kind of aid. And also you'll have a differentiated approach, right? We're looking at the next generation, the second generation and beyond of these drugs.
So, when it comes to the ability to meet that demand, right? So much of the conversation has been centered around supply, lack of supply, what so many of these bigger players are doing, trying to address that. What's the realistic timeline just in terms of getting more manufacturing online and realistically maybe being able to meet that demand in the future?
So some plants have existing capabilities, like an Amgen does. They have huge plants around the world and they can work on this, but they have to build and they have to put money into it. And I don't think we necessarily have a timeline. I think Eli Lilly talked about a couple of years recently to be able, if they were to address all of it. But you're going to have multiple players, and so I think there's going to be significant investment. Maybe there's a way to use contract manufacturing organizations and bring them into the process here, and then other players will decide. But I think what everybody realizes is based on the opportunity, the investment in manufacturing and supply has to come in much earlier than perhaps thought before.
What inning are we in to getting the amount of supply to reach the demand?
I mean, maybe the first third.
Yeah. A lot of room.
It's been incredible to watch the excitement surrounding so many of these players and also just the real opportunity. You mentioned about $130 billion, did you say was the trust?
Huge.
Yeah, it's massive.
Yeah. All right. Well, thank you so much, Sylvain, for coming in, especially after your travels. Really appreciate it. Thank you so much.
Great. Thank you for having me.
Thank you. Sylvain Richter, Goldman's U.S. lead biotech analyst. Appreciate it. Thank you so much. Now, coming up, we've got Wealth dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you here for the next hour, so stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, Elon Musk scored a big victory with Tesla shareholders. We'll break down what this means for the stock price and whether or not now is the time to invest. And mortgage rates easing a bit further this week, but meaningful declines don't seem to be in the cards anytime soon. We'll break down where rates and prices are heading in the next year. Plus, what's a cash management account and why is it the right time and right investment for you? We break down this with our trusty personal finance reporter. We've got all that and much more throughout today's show. But hey, our top story today, Tesla shareholders reapproving Elon Musk's multi-billion-dollar compensation package, which was struck down by a Delaware judge earlier this year. Now, there's a lot of chatter across Wall Street about what ripple effects this has for the company, shareholders, and the value of the stock, of course. Taking a look at Tesla shares 90 minutes into the trading day, we're seeing a reversal of some of those earlier gains. Here with more reaction, we've got Dave Harden, Summit Global Chief Investment Officer. Dave, we've had a few guests on Tesla today and everybody having something to say about Tesla, a couple different perspectives here. Let's start things off just setting the tone with what they had to say, and then I'll get your reaction on the other side. Okay, we're going to work on getting that shot. Dave, let me just get your reaction to what we saw in the voter and the shareholder vote yesterday.
Well, I think that there's a couple things. One, it does align Musk's interests with the company. Let's face it, he's very incentivized now. It encourages him to drive Tesla's growth, and it helps to retain him. He's not going anywhere. And it's a big vote of confidence. That's the pros. The negatives here is very easy to see. This is excessive. This is a very large compensation package. It's significant dilution possibilities for shareholders. And it causes one to want to do things that are risky. Now, that's nothing new for Elon Musk, right? So we know his personality, but it also creates the possibility for income inequality throughout the company. If someone right above you is making $56 billion, and you're making 56,000, there's this large, disparity. So what does it do to the workers as well? They just laid off a lot of workers. So these are kind of the issues at stake right now.
And so, Dave, it was perhaps a little bit of a tease for that shot here. We do have it now. We've had a couple guests on Tesla today, and we've seen a couple different perspectives and opinions about where the company's headed. Let's take a listen, and then I'll get your reaction.
Betting against Musk, it's been the wrong move. And I think this has clearly been a turbulent period. But I could see that Cinderella story starting again as we go into 2025.
Tesla is the biggest stock market bubble in world history. My price target is $15.
So, Dave, what say you? Where do you fall on this debate?
Well, I don't know if it's going to $15, and I don't know if it's going to the moon, per se. But I wouldn't buy Tesla at this time. Elon Musk is an outspoken leader, and I think that there's going to be much more chatter and much more opportunity to get in when you can see clearly that the growth is going to happen. So the major growth is behind us. We know that. That's very clear. But I think you're going to hear more about that in the future. So the other thing I would say is that this is, 1.6 beta stock. This is an 80 plus PE. I know that's not the story here, but there's a lot of unpredictability with Elon Musk. So if you're a managed risk investor, I would probably hold off on this investment. If you're a growth investor, I would also probably hold on. So my thing right now, I would recommend to hold on Tesla and wait. If you're in the shares, I'd probably sell.
Interesting. Okay, so Dave, this comes back to the importance of Elon Musk. And Dan Ives was telling us earlier that Tesla is Elon Musk is Tesla. And there's always going to be the overhang, the thought for investors about how much time he's committing to Tesla versus his other entities. Does this solidify for investors that they're going to get even more of his attention because it's always going to be divided. It's never going to be undivided?
Well, absolutely. It gives him more attention than he's had before. That is for sure. But he is a serial entrepreneur. He's a producer. He's a doer, right? So I don't think this is going to stop him from wanting to make things happen in other areas of his life and in other companies. That's for sure. But I do think that this does align his interests. And so for those that are worried about Elon, worried about keeping him with the company and worried about his focus, I can see why they approve this to keep him there, because it definitely does that.
And so, Optimus, a lot of people are trying to also figure out, does robots change the investment thesis on this company?
You know, there's a lot of opportunity here for sure, but no, I don't think that does that at this time. I think that it's more of a wait and see. Let's see what he does. He's done a lot of entrepreneurial things and brought this company to be where it's at today. But what can he do with it from here on out? That's the question.
You know, even as we look here on out, what kind of company do you believe this is, Dave? Is it an automotive company? Is it a technology company? Is it a energy company?
Well, with this new package, it's not going to be just an automotive company. There's not enough room for growth in just automotive alone. He has to turn to AI. He has to turn to other areas to get the growth that he wants. We know the vehicle sales where they're at. They're not going to move that much for his taste. So this has to be more than an automotive company if you're investing for growth. If you're investing for automotive, then you're probably in the right space. Slow growth ahead.
And you mentioned whether or not investors should be investing in Tesla at this juncture, and you said no. So where else are the opportunities you would be looking at?
Well, there's a lot of other opportunities. For example, if you're really looking to invest in Tesla, you're looking for growth. And I don't think you've missed out on some of these AI momentums that are happening right now. And let's just take a look at Microsoft. Microsoft has high quality earnings. Microsoft has AI opportunities that it's just beginning now to unleash. And I think the next phase of AI is in the software and unlocking the value of AI within. Wouldn't it be nice if AI was right in Microsoft Excel, Microsoft Outlook, Microsoft, et cetera? The software opportunity for AI is just beginning. And so I think there's other opportunities for growth that are much more prevalent and at hand, where Tesla, I think, is in the future if Musk can do it.
All right, Dave Harden, Summit Global Chief Investment Officer. Thanks very much for taking the time here with us today. Appreciate it.
You're welcome. Thank you for having me.
Certainly. A lot of economic data out this week. To discuss what the data is telling us and what it means for you, Yahoo Finance's very own Julie Hyman is here. Hey, Julie.
Hey there, Brad. So as we take a look at the economic data this week, the economic data we've gotten this year, a lot of economists have talked about the weakness that we have seen, or at least the mixed data. But this week, we got some more better news on inflation. So let's start with the Consumer Price Index, the measure of consumer inflation that came out on Tuesday here. And we saw it, or on Wednesday, excuse me, and it rose 3.4% year over year. That's what we got right here. That gain, that was the slowest that we have seen in more than 3 years, and that was seen as a big measure of relief, right? 3.4% is still an increase, to be sure, year over year. That's core CPI, by the way, excluding food and energy. But directionally, the gains year over year in CPI, as you can see here, are getting smaller. So you have deceleration or in inflation or disinflation. Put another way. We also saw that on the wholesale level. So what are the companies that you buy from paying to make their goods and services? And so that too, we saw producer prices actually falling on a month-over-month basis, which hasn't happened in a long time as well. And on a core basis, we also saw a slowing of inflation. But then today, you also got consumer sentiment. And that showed that even if inflation data is decelerating, it's not something that consumers feel real great about, because they are still seeing, for example, 3.4% higher prices year over year. So if you look at this number, you've got a 7-month low for that consumer sentiment. In early June, it was worse than expected, and people are still expecting higher prices as well. So they're still expecting to pay an inflation rate of about 3.1%, not just this year, but over the next 5 to 10 years. So consumers are expecting that higher for longer inflation. The other thing, Brad, that I found an interesting tidbit in that report is that consumers' assessments of their own finances, their personal finances, was down the lowest since October. This is even as we see stocks hitting new highs, for example, but it seems to reflect perhaps a little bit more uneasiness about incomes and about the job market.
All right, so what does all this data mean for the Fed as well?
Yeah, we got to put it all together, right? So the Fed, as we heard from Jay Powell on Wednesday, welcomes this slowing in inflation, in the rate of inflation. Again, just to be clear, prices aren't going down, they're just going up at a slower rate, which is what the Fed is looking for. But of those numbers we talked about, the Fed watches inflation, watches CPI, it watches PPI, it watches the job market, it watches even sentiment. We've seen the Fed react to that in the past. But the real number that they pay the most attention to when it comes to inflation is PCE, which stands for personal consumption expenditures. What the heck does that mean? It is basically just another way of weighting those consumer prices that we pay. So, for example, there are different components that have different weights. Housing, a little bit of a lower weight in PCE, for example. It's composed a little bit differently. In April, we saw year-over-year core PCE up 2.8%. Now, we're going to get in a couple weeks the next reading on PCE. There's been a lot of forecasting based on what we saw from inflation numbers already. And the forecast right now, the consensus is 2.6%, which would be the lowest in 3 years' time. So that, too, would be good news for the Fed, would mean maybe we're getting a little bit closer to the Fed cutting rates, which, as we've talked about before, affects a whole host of things that affect you and me and everybody watching right now, from mortgages to auto loans to much more.
Julie, excellent breakdown. Tees up our next conversation as well. Yahoo Finance's own Julie Hyman. Well, as we were mentioning, the Federal Reserve, or Julie was there, the Federal Reserve holding interest rates at a 23-year high this week, while reducing its estimates of rate cuts this year from 3 to 1. These higher rates are good for short-term savers due to higher yields on savings accounts like CDs. Here with more, we've got Yahoo Finance's Carrie Hannon. Hey, Carrie.
Hey, Brad, great to be here. Yeah, I mean, savers should be dancing that happy dance, the jig, whatever it might be. This is great news. I mean, for right now, these are some of the highest rates we've seen for savers, for the accounts you just mentioned, for money markets, for online savings account, high yield ones. We've got T-bills are looking great, money markets. These are areas that you can just swish some cash over into, and it's a great area for peace of mind, particularly for people who are nearing retirement or in retirement. Because here's what happened, Brad. A lot of people actually slow down and they don't realize how much they're likely to spend in the early days of their retirement. And so they don't put enough cash aside. This is a perfect time to set that cash aside so you can pay yourself, have expenses, living expenses, for maybe a year or two shifted into some of these accounts. And these are the kinds of rates we're seeing, okay? If you look around, they're over 5% easily. I saw a one-year CD yesterday for 5.65%. And T-bills are paying over 5, or yielding over 5%, and they are exempt from state and local tax. So these are all some really great ways to kind of build a risk buffer, I like to call it.
So, Carrie, is it time to dump all your money into these short-term savings like CDs, or do you need to stay diversified here?
No. Hold down. You got to hold your horses on this one. We all still need equities in our portfolio because, hey, we're talking about living to 100, a lot of folks. So if you got that kind of longevity for retirees too, come on, you've got to be thinking of the oomph you can get from the equities. And we know that that's an important engine to keep our money growing for us over the long term, even if it's 10 years, 20 years. The S&P 500 index is up, I think it's something like 10.7% since its inception annually. So, think about that. Stocks are an important part of the equation. One sort of, it's a standard thing that people often say. It used to be take 110 minus your age, and that's how much should be in equities. Today, people are saying because of the longevity, let's go with 120 minus your age for how much you should have in equities. But don't ignore these great rates that we're seeing right now for these short-term savers.
Carrie, thanks so much. Appreciate it. Excellent coverage as always. Well, we've got all your markets action ahead. We're just getting started here on Wealth. Stay tuned. Mortgage rates ticked lower once again this week with the 30-year fixed rate at 6.95% there. Yeah, 9 probably gave some of you guys a heart attack out there. Anyway, still hovering just below that 7% mark. So, for what the latest numbers could mean for the housing market, let's bring in Yahoo Finance's very own Rebecca Chen, live from the West Coast. Hey, Rebecca.
Hey, Brad, that's correct. The average 30-year mortgage rate declined further below 7% this week to 6.95. While this is better than what we've seen earlier this month, it is a lot. Experts are saying it's still too high for many home buyers, and the reason is simple. Borrowing cost is too high for today's home prices. Experts say consumers are looking for a more substantial decline before they return to the market. And what that substantial decline will look like, it's not really a magic number, but experts say they're looking for a trend. And this trend will come from the Federal Reserve when and if they begin trimming rates. But the confidence in that has been quite low among Americans. A survey by Fannie Mae recently has shown that 30% of Americans actually believe that rates will go up over the next 12 months. And this is higher than those who believe rates will go down over the next 12 months. So there are actually more people thinking that rates would increase next year. But there could be some light at the end of the tunnel. Economies from Bank of America are now forecasting about 6 rate cuts over in 2025 and 2026. So the way to think about this is the rate cuts that we thought were going to happen in 2024 is being pushed back over to the later 2 years. And when that happens, or if that happens, it could bring a lot more relief to home buyers who have been waiting for more affordability in the market.
Rebecca, excellent tee up for our next conversation here. Yahoo Finance's own Rebecca Chen. Well, home buyers are grappling with a difficult housing market and wondering when they can see themselves some relief out here in these streets. Rates are just below 7%, but meaningful declines could still be months away. Here to weigh in, we've got Jennifer Beeston, who is the Senior Vice President of Mortgage Lending at Guaranteed Rate. Great to have you here in studio with us today.
Thank you for having me.
So for home buyers out there that potentially have some meetings and appointments set up over the course of this weekend, and are also trying to remember how they can negotiate mortgage rates, what is the top tip that they need to remember going into all of these discussions?
Well, there's a couple top tips, but the biggest one would be research the lender you're talking to. A lot of times people are just calling, well, what's the rate? What's the rate? But they're not asking about the fees. They're not asking about discount points. They're not asking the questions they need. So I would say find a lender with really good reviews, and then I would talk to the lender way before you're going to shop and talk to them about the rates, the fees, and then compare lenders based off of that. Because it's more than just the rate. It's what they're going to charge you for that rate.
What's the common pitfall that you see as people are, it's of course emotion, it's the spending and trying to make sure that you're not getting taken advantage of out there in the housing market as well. What are some of the top pitfalls that are most frequently repeated?
So one of the biggest concerns that I'm always telling people about is, look, if a lender's quoting you a rate, you need to see in writing if there's discount points and if there's fees, because what's happening in the market right now is a client will call a lender, they'll say, hey, I really want 6%. And the lender goes, yeah, I got that. But they don't say, I got that, and it's going to cost you $10,000, $12,000, $15,000. So I'm looking at loan estimates all the time because I just tell people, send them to me, I'll look at it. And I'm like, hey, how much did the lender say it was going to cost you for this rate? And they go, nothing. And I go, well, it says $20,000 right here. So you really need to check everything is the biggest tip I have.
Check everything, even into some of the contracts that you sign with real estate agents as well.
Yes.
We were discussing this just in the green room a moment
Yes.
ago here. Why is this so frequent right now?
Well, because of the NAR lawsuit, starting in August, real estate agents are going to be requiring these buyer's agreement before they show a house. And we're already seeing agents do them. And my biggest concern and what I'm seeing that's alarming is that these contracts are being sent to buyers without being explained, and the buyers are signing them without reading them. So you've got both commission being locked in with a real estate agent, and no one's reading it. And this is negotiable. This is big money that could hurt your wallet. So that's one of my big fears moving into the rest of this year is what's going to happen with those agreements.
And so within those agreements, what should you be going through and redlining as part of that negotiation?
Yeah, I mean, look, I would definitely be discussing the commission. Are you willing to pay the commission? Before this year, the concept of a buyer paying a real estate agent's commission was foreign, but because of the NAR lawsuit, it's on the platter. So, A, are you willing? B, how much do you want to pay? There's no set amount in the industry, and I think that we really need to do a lot of education about that. And then lastly, time period. You could have it where you just sign an agreement for one house, but a lot of agents are sending these out saying, hey, you've got to work exclusively with me for a year.
There are a lot of new first-time home buyers that are trying to figure out, okay, where are we going? What is the region that we want to be in? What is the fair price that seems applicable for that region? What should they be going through in their own thought process as they're trying to make that first-time home purchase?
In terms of where they're living or in terms of signing a buyer's agreement?
In terms of where they're living, in terms of the type of home, just the top considerations.
Oh, I mean, look, a lot of it's going to depend on, do you need to be close to your job? That's number one. If you don't need to be close to your job and you can be a remote worker, which is what we saw a lot of in 2020, 2021 and 2, where do you want to live? Really just taking time to write down your goals before you start shopping, because otherwise people fall into, I would almost say, a Zillow days, where they're just looking at houses everywhere in the country without thinking about school districts, proximity to work.
This feels like a personal attack right now, Jennifer.
Are you home buying? Oh no, how many hours are you on Zillow a night?
I mean, look, you just always are on Zillow, just trying to figure out what's out there.
Look, I've done it. I've been at the point where my eyes, I can't open them in the morning. So I feel you, but you got to write down a list of your goals and you got to stick to it. Don't fall in the days.
Jennifer, thanks so much for joining us here in studio. Appreciate it. Jennifer Beeston, who is the Senior Vice President of Mortgage Lending at Guaranteed Rate.
Thank you for having me.
Absolutely. Well, as mortgage rates come down below 7% again, can consumers expect homes to become more affordable? Let's dive into the latest forecasts from industry experts on where the national home prices are expected to go through 2027. Before that, we've got Yahoo Finance's Danny Romero with the breakdown. Hey, Danny.
Hey, Brad. Potential home buyers who are trying to jump into the housing market are facing many barriers to entry. High home prices, high mortgage rates, and that limited housing inventory. But is there hope on the horizon? Goldman Sachs believes that the rate at which home prices grow will stay at its historical average of 4.5%. And this year, the investment bank expects home prices to appreciate 3.8%. Now, that is down from its 5.5% appreciation expected back in February. Now, next year, they do expect home prices to appreciate 4.4%, and in 2026, 4.9%, and in 2027, 4.9%. Now remember, there could be a regional home price correction during this period, but on the other hand, Moody's, the credit agency, expects home prices to grow 1.5% this year, and then the next year, home prices to appreciate 0.3%, and in 2026, home prices to grow 0.9%. Then finally, wrapping up in 2027, home price appreciation they're expecting will be about 1.7%. Now, this is a different picture to Goldman Sachs' outlook because Moody's expects that homes for sale will steadily increase as people who own a home currently will likely sell due to life circumstances. Moody also expects mortgage rates to move lower. That will also put some pressure on home price gains, Brad.
All right. Danny Romero, thanks so much. Tracking all things in the housing market always. Thank you. We've got much more on wealth after the break. You're watching Yahoo Finance.
a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
You could customize anything nowadays, but how can you customize your investments? 84% of workers would like to see more personalized investment options in their 401ks. This is according to Franklin Templeton, to discuss the importance of personalization and how it can help you achieve your wealth goals. Kevin Murphy, Franklin Templeton, head of institutional retirement and strategic growth, is here. Kevin, great to see you. Thanks for coming in studio. I mean, obviously this is something that needs to be customized, needs to be personalized, because everybody has different personal finance goals and a different, perhaps, horizon that they're looking at as well. But as it relates to that employer-employee relationship, where do you hear more employees calling for flexibility as well?
Well, yeah, that's the research that you referenced, and nice to be here. Thanks for having me. We've done it for 4 years now, the voice of the American workplace, and really the catalyst was we wanted to validate. We had a feeling, our clients had a feeling, how people, how participants and how employers are feeling about their overall benefits. So we set out on a project with the Harris Poll in partnership to really dig into how employees are feeling about their benefits. And this was our 4th year. The recurring theme we hear each and every year is that personalization has now become non-negotiable. Absolutely non-negotiable. It's what the stat that you mentioned in the opening, that is absolutely the case. And even more so, another 80% also want more personalized across their entire benefit stack, not just their 401k plan. So the other stat I reference often is that 45% of millennials have admitted to quitting their job because of the low quality of benefits. Wow. The way I look at that when I'm talking to employers is this is a talent retention tool and a talent attract and retain key talent, especially the millennial generation, because they need and they want more personalized benefits.
I was just about to ask you the difference or the delta between generations here, because Gen X was essentially and has come to be known as the 401k test case generation. But how has personalization and some of the requests changed generation over generation based on what we've seen with millennials and now what we're seeing increasingly with Gen Zers and then eventually the next generations that come in the future too?
Yeah, it's a great question, because over 10,000 boomers a day are turning 65 right now.
Wow.
And these retirees, if they had access to a 401k plan, were the early 401k. So then you get to the next generation, and for me personally, I'm a Gen X, and every day since my first day of work, and I also work in the financial industry, it was contribute as much as your 401k, you're gonna be sorry if you don't. And that's not how this generation thinks. This generation thinks, okay, I need to think about retirement kind of, sort of, but I need the here and the now. And that's really what personalization to us means. And what we're preparing for as a firm is to really meet each individual according to their life stage. What's important to them? If they're in their 20s, they might be interested in paying off student loan debt. They might be interested in buying a car, buying a house. It's okay to plan a nice vacation. We have to live our life as well, but it's really about having multiple goals, having a plan in place, making retirement a part of the conversation, not the only conversation. And that's another thing we talk about is we think it's time to retire the word retirement. It's really more about financial independence. It's about financial independence, meeting individuals along their journey and leveraging technology to deliver it through the workplace in a very convenient and simple way.
It's great that you mentioned technology. That's exactly where I was about to go next, because I think a lot of people just don't even know the access points sometimes, or even if you change jobs, where things carry over. How are we simplifying the delivery of making sure that someone has full insight or full vision into how they're tracking up against their goals?
It's a great question, and it's changing at a rapid pace now. The legacy, we're breaking through some of the legacy narrative. We think that you need to make it very convenient. You need to make it very simple, and you need to make it personalized. And that's what we believe, and the voice of the American workplace has helped us with this. And we believe the workplace has become the financial epicenter for most working Americans. And there's a few reasons why. One, the big one is the trust factor. There's an inherent level of trust between the employer and the employee. Employees might not always like their employer, but they trust their employer. They have sensitive data. This group of employees, the average U.S. worker, are not traditional targets of our wealth management industry. They're not high net worth households. Their primary savings vehicle is largely going to be their 401k plan. And third is the big one, it's data. We have the data, we can use the data. We're seeing great advancements in technology, delivering it through the workplace in a very convenient, simple, and personalized way.
You mentioned that this can even be a talent acquisition or talent retention type, or hold the importance of talent acquisition and talent retention as well in this personalization and customization. Who, from an industry or sector perspective, is doing this well, hitting it out of the park and allowing this personalization so that they're not losing employees in droves?
Yeah, we see, honestly, I would maybe reframe the question. There are very forward-thinking, innovative advisors, financial advisors that specialize in working with corporate retirement plans have started to implement solution. Financial wellness is a very largely used term, but it's really misdefined. If you use an internet search and you put in financial wellness, you're going to get 700 million hits in less than a second. It's not a content problem, it's an engagement problem. So really the advisors that are out in front of this, engaging with their employers, engaging with their employees, leveraging technology, they're the ones that are truly moving the needle because they're meeting individuals where they are in their life stage.
Kevin Murphy, who is Franklin Templeton Head of Institutional Retirement and Strategic Growth. Thanks so much for taking the time here with us today, Kevin.
Thanks for having me.
Absolutely. Everyone, coming up is the upcoming presidential election giving you financial anxiety. You may not be alone. We'll have more after the break.
Originally inspired by General Motors ending its EV1 program, Tesla has become the world's leading electric vehicle manufacturer. In 2023, Tesla generated nearly $97 billion in revenue, and its market cap is over $570 billion. The company was Yahoo Finance's top trending ticker of 2023, with over 300 million page views. Let's take a look at some of the company's biggest moments with Beyond the Ticker. Originally named Tesla Motors, Tesla was founded in 2003 by Martin Eberhard and Mark Tarpenning. Elon Musk joined the company in 2004, investing over $6 million of his own money and becoming chairman of the board. In 2006, Tesla unveiled the prototype for its Roadster, which entered production in 2008. It was the first all-electric car to use lithium-ion battery cells. After co-founders Eberhard and Tarpenning left the company, Musk took over as CEO in 2007. On June 29, 2010, it went public via IPO on the NASDAQ at $17 per share. In 2016, Tesla unveiled the Model 3, its first mass-market vehicle. Later that year, Tesla agreed to acquire SolarCity for $2.6 billion. On July 6, 2017, Tesla's stock crashed after delivery concerns. The company lost more than $12 billion. Defying expectations, Tesla recorded 4 profitable quarters in a row from 2019 to 2020, making it eligible for inclusion in the S&P 500. On November 4, 2021, the company reached an all-time high stock price of $409.97. Originally introduced in 2019, the first Tesla Cybertrucks were delivered to customers in November 2023. Tesla continues to produce despite its setbacks due to lawsuits, manufacturing delays, and Musk's controversial statements. Investors will continue to wait for the next wave of innovation from the world's most valuable automaker.
Americans continue to worry about their own personal finances, and electoral politics are not helping. According to a new study from D.A. Davidson, 78% of Americans are anxious about their finances within the context of November's election, with 60% expecting inflation to rise as a result. For more on the study, we welcome in Andrew Crowell, who is the D.A. Davidson Vice Chairman, Wealth Management. Thank you so much for joining here. One of the huge things
Thank you, Brad, for having me.
Absolutely. One of the huge things that we're trying to figure out is, because we don't have a crystal ball to know who's going to win, it also comes to some of the down ballot voting as well here, and where some of the elected officials could have sway on policy that could impact anything from the prices we pay, even though the Fed is still going to perhaps reign supreme within that trajectory. I mean, where should voters be placing more of the emphasis on their financial concerns?
Well, it's a great question. You know, we have an unusual year this year with the presidential election in that it's the immediate president and the immediate past president who are the two front-running candidates. So investors and Americans have some insight as to the policy distinctions between both administrations. And I think with the tight election polling so far, investors are just uncertain about what the outcome is going to be. And it was kind of shocking that 85% of those Americans that we surveyed said that they were anxious about the election outcome and how it would impact the financial markets. So the uncertainty is palpable.
And so with that in mind, I mean, we're taking a look at some of the survey results here. It also even extends into data about student loans here. I mean, what is the net impact that people should be or could be expecting there?
Well, inflation has been something that we've all felt over the last couple of years. And it was fascinating that 42%, actually it was 43% of the people that we polled that have student loans outstanding have been unable to keep up with their payments since they were reinstated starting in 2023. We saw other things like 47% of those that we surveyed are currently not contributing to their retirement plans. And then we had almost a third, 32%, that said they don't even have any retirement savings at all. So persistent inflation is impacting people in the pocketbook, and they're making choices. And unfortunately, they may be sabotaging their long-term savings by not contributing during this time period.
And so there's also one stat that really jumped out to me here. 40% of Americans who have a second job got one in order to afford basic expenses. This comes back to what we were just discussing in the affordability and the cost of living right now. Just help us kind of walk through the mindset that consumers are really navigating right now with regard to employment and wages offsetting the higher cost of living.
Well, you said at the top of the segment, 60% of those that we polled said that they expect the election outcome to cause an increase in inflation. Shocking to me. I don't know if that's because they anticipate more fiscal spending or they just persist. So people are making these choices, and it's making it very difficult for the average consumer to keep ahead. That stat that you cited about second jobs, 42% of those who have second jobs took them on in the last year. They're not taking it on to get ahead. They're taking it on just to simply make ends meet. So this election really may be about inflation and the impact that it's having on the consumer's wallet, because people are just trying to, even with in a state like mine, in California, where we have minimum wage increases going through, people are still not feeling good about their financial situation. They're paying more at the grocery store and more at the pump, and as we said, they're unfortunately making decisions not to contribute to their 401k savings. At least almost half of them are not.
And so let's just name the two leading candidates right now, Biden and Trump. In one case, Biden is seen by many as the person who's in the White House where a lot of this inflation is taking place, whereas Trump is meeting with top CEOs and they're trying to evaluate to what extent inflation could get worse because of tariffs that might be enacted or added on to. So all this in mind, where do you believe Americans are placing even more emphasis?
Well, I think they're placing more emphasis based on what we can tell right now in just that either administration is going to be spending and either administration is going to be putting pressure on both wages and also on everyday expenses through their policy. So it's a question of will investors take a long-term approach and take a look at their own personal financial situation and make a decision to prioritize their own saving for the future. If starting later doesn't help you get ahead as much as starting early and being consistent with it, even if your initial contributions are smaller. So I think investors and Americans, as they go to the polling place this fall, they're really going to have to take a look at their long-term future and which candidate they believe is going to best help them get to their own financial goals through their policy actions. And, whereas a few years ago, it was all but a foregone conclusion, we thought that in 2025, a lot of these Tax Cut and Jobs Act provisions were going to be sunsetting. Now it's not so certain. And so we've seen some of our investors running to make some estate planning changes just because they know what the limits are now and they want to take advantage of them now because they don't know if they're going to change in the future or not. So it's really a question of, do I have my own personal financial plan in place? Am I working it with an advisor? And am I being intentional about making decisions today that will help me achieve my longer term financial goals, no matter who's in the White House?
Certainly. Andrew Crowell, who is the D.A. Davidson Vice Chairman of Wealth Management. Thanks so much for taking the time here with us today, Andrew.
Thank you, Brad.
Certainly. Everyone, we've got much more on wealth after the break. You're watching Yahoo Finance.
From creating graphics cards for gaming to becoming one of the world's leading AI chip companies, it's safe to say Nvidia is officially one of the tech giants. In 2023, the company generated nearly $27 billion in revenue, and its market cap is currently hovering at around $3 trillion. Let's take a closer look at what led to Nvidia's boom with Beyond the Ticker, where we dive into the company's biggest moments. Nvidia was founded on April 5, 1993 by Jensen Huang, Chris Malachowski, and Curtis Priam, with a vision to bring 3D graphics to the gaming industry. In 1997, Nvidia launched its first hit product, the NV3. It would later go on to sell a whopping 1 million units in its first 4 months of availability. On January 22, 1999, Nvidia went public via IPO at $12 per share. And in 2000, Microsoft chose Nvidia to develop the graphics hardware for the first Xbox console. 5 years later, Microsoft's rival Sony chose Nvidia's hardware to power the PlayStation 3. In 2010, Nvidia became the graphics chip supplier for automaker Audi. And in 2015, the company launched its Nvidia Drive chip for powering driver assistance technologies. In 2016, Nvidia kicked off its AI efforts with the launch of the DGX-1. 2 years later, the company debuted Nvidia RTX, the first GPU capable of real-time ray tracing. That same year, Google announced it was using Nvidia's Tesla P4 graphics cards for its Google Cloud platform. In 2022, Nvidia debuted its H100 graphics chip for AI, which still stands as one of the world's most powerful chips for artificial intelligence apps. On June 5th, 2024, Nvidia eclipsed that $3 trillion mark, joining the ranks of mega companies Apple and Microsoft. The stock continues to surpass its all-time highs over the past month and is currently trading well over $1,000 per share. From a company of 3 engineers working on graphics cards to thousands of employees working on chips that will power the AI supercomputers of the future, Nvidia remains at the top of the tech industry.
Well, I hope everybody out there has a checking and a savings account, but have you ever heard of a cash management account? It basically combines the features of a checking and savings account into a single account and typically offered at a brokerage or investment firm, and it could streamline your banking. To break this down for us, we've got Yahoo Finance's very own Molly Moorhead here with more. Hey, Molly.
Hey, Brad. Great to see you. I think of these accounts as for people who have investment accounts at places like a Vanguard or a Fidelity. And so having a CMA lets them do their banking all in the same place. And the account is going to include a lot of the same features as a bank account, like a debit card, check writing. You can pay your bills out of the account. And it's usually not going to have any kind of monthly fee associated with it.
So what's the difference between a cash management account and of course, what we had seen historically in other accounts, checking and savings particularly?
The main difference, as you mentioned, is that it's housed at a brokerage or an investment firm. So you're not going down to your local bank branch to do your banking. But it also is going to earn interest. There are, of course, some interest-bearing checking accounts out there, but it's not typical. And then this account acts like a combo of checking and savings, where at a bank, those would be two separate accounts.
So what are the pros and the cons of a cash management account?
The cons, I would say, again, no in-person banking. If you like to walk in and talk to a teller and ask about the different products available, this is not offered with this type of account. It's really all managed online. And another potential drawback is that you might find better interest rates at other places. A high-yield savings account at an online bank might pay a better APY than a cash management account. But the pros are that they offer higher insurance limits. So the FDIC insurance that you get with a bank account is capped at $250,000. But with this account, the investment firm that manages it for you partners with a bank to house the money, and they can offer a higher FDIC limit. So if you've got, a high balance, more of your money will be insured. And then again, I think it's that simplified, all-in-one money management. You use the word streamline. It just kind of lets you do everything from one place.
Yahoo Finance's own Molly Moorhead. Molly, thanks so much for helping us end off the show strong here. Appreciate it. Everyone, that's it for Wealth. I'm Brad Smith. Thanks so much for watching. Stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern Time. You do not want to miss it.